Welcome to the Series 65 exam preparation journey, where we will methodically dismantle the complex requirements of the Uniform Investment Advisor Law examination. By the end of this curriculum, you will possess the precise knowledge required to navigate the regulatory landscape and pass this rigorous credentialing exam with confidence. Disclaimer: this content is for informational and educational purposes only and does not constitute financial, legal, or tax advice. Always consult a qualified professional before making financial or legal decisions. This course is an unofficial, independently produced study guide and is not affiliated with, endorsed by, or connected to FINRA, NASAA, or any other official testing body. All trademarks belong to their respective owners. The NASAA Series 65 exam is a substantial undertaking designed to assess your competence as a financial professional. You will encounter exactly 140 questions in total, though only 130 of these are graded toward your final score. The remaining 10 questions are experimental, distributed throughout the exam to calibrate future iterations of the test, and you will not know which questions count until you receive your results. Given the 180-minute time constraint, you must balance accuracy with a consistent pace to navigate successfully. With 92 correct responses required to hit the 70.8% passing benchmark, there is very little room for error. Your path to success begins with the administrative logistics of the registration process. Everything starts with the submission of Form U-4, which serves as your official notification to state and federal regulators that you intend to sit for the exam. Once approved, you are granted a testing window, typically 120 days, within which you must schedule and complete your session through a designated testing vendor. It is imperative that you verify the specific deadlines associated with your testing window, as failing to sit for the exam within this time frame will result in a forfeiture of fees and the need to restart the application process. When you arrive at the physical proctoring center, expect a high level of security and rigorous identity verification. You will be required to present valid government-issued photographic identification, and your biometric markers, such as palm vein scans or digital signatures, may be captured for security purposes. The testing environment is strictly controlled to ensure the integrity of the exam, meaning you cannot bring personal items, including calculators, notes, or mobile devices, into the room. The system provides a digital calculator and scratch paper, so ensure you are comfortable using these electronic tools prior to your test date. Study efficiency is the primary difference between a candidate who struggles and one who succeeds. I recommend adopting a text navigation paradigm that prioritizes understanding the Uniform Securities Act and the Investment Advisors Act of 1940 as the foundational bedrock of your practice. Focus your energy on the specific, measurable rules rather than generalized concepts, as the exam frequently rewards those who understand the nuanced, verbatim constraints of the law. Effective self-regulation means tracking your mock exam scores across different domains to ensure your preparation aligns with the actual question distribution on the real exam. Once you pass the Series 65, your professional obligations are only just beginning regarding continuing education. The industry maintains specific frameworks to ensure advisors stay current with market changes and regulatory updates. You must be proactive in tracking your firm's compliance requirements and any state-specific renewals that might apply to your registration. Consistency is the primary factor in your eventual success, so stay focused on the mechanics of the law as we proceed through these lectures. See you in the next lesson. Welcome to the chapter on macroeconomics, where we will examine the systemic forces that shape capital markets and influence investment decisions. We are going to explore how monetary policy and fiscal interventions dictate the broader financial landscape. Understanding the Series 65 exam requires more than just memorizing facts. You need to grasp how the economy actually functions. This course is designed to strip away the noise and focus on the mechanics of the Federal Reserve and legislative fiscal policy. By mastering these concepts, you will build the analytical foundation necessary to interpret market movements and advise clients with genuine insight. We will bridge the gap between abstract academic theory and the practical application required to pass your test. Join us now to gain the clarity and precision needed for your professional success. We begin our analysis by looking at the Federal Open Market Committee, or the FOMC, which acts as the primary architect of monetary policy in the United States. Its primary tools involve open market operations, which entail the buying and selling of government securities to influence the federal funds rate. When the Federal Reserve buys securities, it increases the money supply, effectively lowering interest rates to stimulate economic activity. Conversely, selling securities contracts the money supply, which exerts upward pressure on rates to curb inflation. These actions serve as the levers that manage the cost of capital throughout the entire economy. As an investment professional, you must understand that every decision made by the FOMC sends a ripple effect through bond yields and equity valuations. Beyond open market operations, the Federal Reserve influences the economy through the discount rate and reserve requirements. The discount rate represents the cost for commercial banks to borrow directly from the Fed, serving as a signal of its policy stance. A higher discount rate discourages borrowing and slows the expansion of credit, while a lower rate encourages it. Reserve requirements dictate the minimum amount of capital individual banks must hold against their deposits, which limits the multiplier effect of bank lending. While reserve requirements are less frequently adjusted than open market operations, they provide a blunt instrument to ensure systemic stability. Understanding these tools helps you predict how institutional liquidity can shift rapidly in response to central bank signaling. Fiscal policy, in contrast to monetary policy, originates from legislative authorities regarding government spending and taxation. When the government increases spending or reduces taxes, it pursues an expansionary policy aimed at stimulating aggregate demand. While this can lead to temporary growth, it often results in higher budget deficits and increased sovereign debt issuance. Taxation policy, meanwhile, affects disposable income and corporate investment incentives, directly influencing the bottom line of firms in your portfolio. You must distinguish between these two forces, as they often compete with or reinforce each other in ways that define the business cycle. The interaction between a hawkish monetary policy and a loose fiscal policy is a classic dynamic that dictates long-term market trends. Tracking the business cycle is essential for any fiduciary concerned with capital preservation and growth. The cycle moves through four distinct phases: expansion, peak, contraction, and trough, each presenting unique risks. During an expansion, production remains high and inflationary pressures often build as demand outpaces supply. The peak marks the transition where the economy hits capacity, often prompting the Federal Reserve to tighten credit. Contraction brings a slowdown in output and rising unemployment, eventually giving way to a trough, where the economy hits the bottom before the cycle restarts. Recognizing where we currently sit in this cycle allows you to adjust asset allocation strategies to match the prevailing economic reality. International macroeconomic forces add a layer of complexity to these systemic interactions that you cannot ignore. Global trade balances and currency valuations influence the competitiveness of domestic corporations in a globalized marketplace. A strong domestic currency might benefit consumers, but can act as a headwind for exporters by making their goods more expensive abroad. Sovereign debt stability metrics are similarly vital, as they provide a glimpse into the creditworthiness of nations and the potential for systemic contagion. The balance of payments report serves as a diagnostic chart for a country's economic health, reflecting the net flow of goods, services, and capital. Mastery of these global variables completes your holistic view of the forces driving market fluctuations. See you in the next lecture. Welcome to our exploration of economic indicators, yield curves, and inflation as they pertain to the Series 65 curriculum. We will examine how macro-level data shapes the investment landscape. To understand the health of an economy, we rely on a trio of indicators categorized by their temporal relationship to economic cycles. Leading indicators are the predictive signals that attempt to forecast future activity, such as housing starts, stock market performance, and manufacturing orders. When we observe an uptick in building permits or a surge in consumer expectations, we are looking at data that typically precedes a shift in the business cycle. Coincident indicators, conversely, provide a real-time snapshot of the economy's current state. These include metrics like industrial production, personal income levels, and current employment figures, which move in synchronicity with the broader business environment. Finally, lagging indicators are those that adjust only after the economy has already established a trend, such as the duration of unemployment or corporate profits. Mastering these distinctions allows us to build a temporal map of economic momentum rather than reacting blindly to isolated data points. Inflationary pressures are measured through calculated indexes, most notably the Consumer Price Index and the GDP deflator, which serve different analytical purposes. The Consumer Price Index measures the weighted average price of a basket of consumer goods and services, providing a clear window into the cost of living changes faced by individual households. Because this basket is relatively fixed, it is an excellent tool for understanding the erosion of purchasing power over time. The GDP deflator, however, is a broader measure that accounts for all goods and services produced domestically, capturing price changes across the entire economy, including those in the government and capital goods sectors. While the CPI may be skewed by the specific habits of urban consumers, the GDP deflator offers a fluctuating basket that adjusts for changes in consumption patterns. Discernment between these two is vital for planners who must choose the correct adjustment factor when considering long-term wealth preservation for clients. The yield curve acts as a visual representation of how market participants perceive risk and time value across various maturity dates. A normal, upward-sloping yield curve suggests that investors demand a higher yield for locking their capital away for longer periods, signaling an expectation of future economic growth and moderate inflation. When this curve flattens, it typically indicates uncertainty about future economic direction, often serving as a precursor to a shift in monetary policy or economic cooling. An inverted yield curve, where short-term rates exceed long-term rates, is frequently cited as a classic signal of impending recession as investors rush toward the safety of longer-term bonds. Analyzing these term structures allows us to interpret the market's collective forecast, provided we remain aware of how central bank intervention can artificially distort these market-driven signals. We must always weigh these shapes against the backdrop of current monetary policy to avoid drawing overly simplistic conclusions. Real returns represent the true engine of wealth creation, calculated by subtracting the inflation rate from the nominal interest rate provided by an investment. If an asset offers a nominal yield of 5% while inflation is running at 3%, the actual growth in purchasing power is only 2%. This distinction is critical when counseling clients on their long-term financial goals, as failing to account for inflation often leads to an aggressive underestimation of necessary capital. During periods of economic distress, we often observe a phenomenon known as widening credit spreads, which is the increased yield difference between corporate and government debt. This spread represents the risk premium investors demand to compensate for the possibility of default in a volatile environment. As the economic outlook darkens, this premium typically expands, providing a quantitative measure for the degree of systemic fear circulating throughout the credit markets at any given moment. See you in the next lecture. Welcome back, and today we turn our attention to corporate financial statement line analysis. Analyzing these components is essential for any professional navigating the complexities of the Series 65 exam. When we examine a corporate balance sheet, we are essentially looking at a snapshot of a company's financial health at a specific point in time. The fundamental equation that governs this report is assets equal liabilities plus shareholders' equity. Assets are classified by their liquidity, meaning how quickly they can be converted into cash without significant loss of value. Current assets include cash, marketable securities, accounts receivable, and inventory, all expected to be realized or consumed within 1 year. On the flip side, we must carefully categorize liabilities, distinguishing between current obligations due within the fiscal year and long-term debt. Shareholders' equity represents the residual interest in the assets of the entity after deducting liabilities, encompassing common stock, preferred stock, and retained earnings. Understanding the configuration of these equity accounts is vital because it reveals how much of the company is funded by external debt versus internal earnings. By isolating these layers, we can determine the solvency and short-term operational stability of an issuing corporation. Moving beyond the snapshot of the balance sheet, the income statement provides a narrative of corporate performance over a defined period. This document layers revenue against operational expenses to derive net income, which investors often use as a primary indicator of profitability. We must be particularly attentive to the distinction between cash-based accounting and accrual methodologies. Under accrual accounting, revenues are recognized when earned, regardless of when cash is actually received, and expenses are matched to the revenues they help generate. This creates a more accurate picture of operational efficiency, although it necessitates a deeper look at the cash flow statement to ensure that net income is supported by actual currency inflows. The cash flow statement is categorized into operational, investing, and financing activities, which allows us to see if a company is generating cash from its primary business or simply borrowing to stay afloat. A company might show high net income while suffering from cash flow issues, which is precisely the kind of nuance the exam expects you to identify. Beyond the primary financial statements, the notes and disclosures within corporate annual reports are where the real substance often resides. These disclosures often reveal off-balance sheet arrangements, litigation risks, and specific accounting policies that could materially alter your interpretation of the numbers. When we look at external reporting, we must differentiate between audit opinions provided by independent accountants. An unqualified opinion, often called a clean opinion, signifies that the financial statements present the company's financial position fairly in all material respects. Conversely, a qualified opinion suggests that the auditor has reservations about certain aspects of the reporting or that the information might be subject to limitations. Adverse opinions or disclaimers are clear red flags that indicate systemic issues with the company's financial record-keeping or transparency. As an investment advisor, your ability to read through the boilerplate and identify these technical variances is what allows for a truly informed evaluation of a security. See you in the next lecture. Welcome back. In this chapter, we will master the quantitative frameworks and mathematical methods required to evaluate equities and security structures for the Series 65 exam. Understanding the time value of money is the foundation for any rigorous investment analysis, as it allows us to compare the worth of capital at different points in time. When we discuss net present value, we are essentially discounting a series of future cash flows back to the present day using a specific interest rate to determine if an investment adds value. Internal rate of return acts as the discount rate that makes the net present value of all cash flows, both positive and negative, equal to zero. If your calculated internal rate of return exceeds the required hurdle rate, the capital budgeting initiative is generally considered financially viable. These calculations are not merely academic exercises, but are vital tools used to determine whether a project will yield a return that compensates for the inherent risks. You will find that mastering the mechanics of these formulas is crucial when evaluating long-term business projects or infrastructure investments. By isolating these variables, we can objectively compare disparate investment opportunities regardless of their specific timing or scale. This disciplined approach prevents emotional decision-making and aligns investment activity with measurable financial outcomes. Moving into descriptive statistics, we must be comfortable identifying the central tendencies and the spread of historical datasets. The mean is the simple arithmetic average, calculated by summing all observations and dividing by the number of data points, while the median represents the middle value in an ordered set. The mode is simply the value that appears most frequently, which can be useful when analyzing skewed distributions or categorical data. To understand the dispersion of our data, we look at the range, which is the difference between the highest and lowest values in a set. Variance measures the average of the squared differences from the mean, providing a mathematical sense of how far a set of numbers is spread out. Standard deviation is the square root of the variance and is perhaps the most critical metric for expressing the volatility of a security. A lower standard deviation suggests that the returns are more predictable, while a higher one indicates greater uncertainty. Mapping these statistics allows you to conceptualize the risk profile of an asset before you ever commit capital to a position. Evaluating the relationship between assets requires an understanding of the correlation coefficient, which ranges from -1 to +1. A correlation of +1 indicates that two assets move in perfect lockstep, thereby offering no diversification benefits if you hold both. Conversely, a -1 correlation means the assets pull in opposite directions, acting as a powerful hedge against each other, while 0 indicates no relationship between the movements at all. Investors utilize this metric to construct portfolios that maximize returns for a specific level of risk by combining assets with low or negative correlations. If you have two securities that always move together, increasing your exposure to both does not actually reduce your systematic risk profile. It is therefore imperative that you calculate these coefficients accurately when assessing how a new security will function within a pre-existing portfolio strategy. Maintaining this diversification is the only free lunch in investing. though it relies entirely on the accuracy of your historical interpretation. Fundamental analysis relies heavily on security valuation ratios that provide a snapshot of a company's financial health and relative price. The price-to-earnings ratio, often called the PE ratio, compares the current market price of a stock to its earnings per share, helping you determine if a stock is overvalued or undervalued relative to its peers. The price-to-book ratio contrasts the market value of the company with its accounting book value, providing insight into what the market is willing to pay for a firm's net assets. Beyond these valuation metrics, we use liquidity tests like the current ratio to measure a company's ability to pay off short-term obligations with its current assets. The quick ratio, or acid test ratio, is a more stringent variation that excludes inventory from current assets, recognizing that inventory cannot always be liquidated instantaneously. Finally, the debt-to-equity ratio reveals the degree to which a company is financing its operations through debt versus wholly owned funds. Together, these ratios create a multifaceted lens through which we can view the operational efficiency and solvency of a corporate entity. See you in the next lecture. Welcome to our exploration of systematic and unsystematic risk, where we will methodically dismantle the components of portfolio volatility to better understand how market forces interact with specific corporate outcomes. By the end of this session, you will possess a framework for distinguishing between risks that can be mitigated through diversification and those that are inherent to the broader economic structure. When we construct a portfolio, we are essentially assembling a collection of risks, and our primary objective as investment advisors is to ensure those risks are properly compensated. We categorize these threats into two distinct buckets, and the distinction between them is foundational to the philosophy of modern portfolio theory. Systematic risk, often called market risk, represents the hazards that affect the entire financial system regardless of the individual merits of a specific company. You cannot escape systematic risk simply by owning a variety of stocks, because it stems from external macroeconomic variables that influence all assets simultaneously. When interest rates fluctuate, or when high inflation reduces the purchasing power of future cash flows, every equity and fixed income security experiences a valuation shift. Geopolitical shocks, such as global trade disruptions or widespread resource scarcity, act as systemic triggers that cause the entire capital market to wobble. Because this risk is omnipresent and inherent to the system, the market does not offer an expected return for carrying it as a unique burden that you could otherwise get rid of. It is the cost of entry for participating in the capital markets, and your role is to quantify it rather than attempt to eliminate it. In contrast, unsystematic risk occupies the sphere of individual entities, representing the specific uncertainties that plague a solitary firm or a narrow sector of the economy. These threats are idiosyncratic, meaning they arise from corporate credit events, shifts in regulatory exposure, or catastrophic operational failures like a data breach or labor strike. Because these issues are localized to a specific business, they become irrelevant if you own a sufficiently diversified basket of assets. The gains in one portion of your portfolio effectively neutralize the losses caused by the failure of another. Asset liquidation risk, which concerns the ability to exit a position without suffering a significant price concession, also falls under this unsystematic umbrella, depending on the volume and market depth of the security. By allocating capital across uncorrelated sectors, an investor can isolate themselves from the potential bankruptcy of a single issuer. This diversification process is a fundamental mechanical advantage that converts uncompensated, company-specific volatility into a more predictable path for total portfolio returns. You are essentially paying for a reduction in standard deviation by broadening your horizon beyond single-point failures. To truly master the management of these risks, we must understand the hierarchy of corporate capital, which dictates the order in which stakeholders are compensated during a liquidation event. At the top of this chain are the secured creditors, who hold specific liens on the assets of the company, followed by the unsecured bondholders, who occupy a subordinate but still relatively protected position. Preferred shareholders sit below the debt holders, and common equity shareholders reside at the very base of this pyramid. Managing these volatility shifts requires a disciplined, analytical approach rather than a reactive one, driven by news headlines or emotional responses. When systematic pressures mount, Hedging strategies using derivatives or shifting into cash equivalents can provide a temporary buffer, although these are rarely long-term solutions for the average retail investor. The goal is to build a core satellite portfolio that recognizes the reality of systematic risks while neutralizing unsystematic dangers through broad, intelligent diversification across different asset classes. By clearly separating these variables in your mind, you prevent the common mistake of overreacting to company-specific news while ignoring the more powerful, macro-level headwinds that are actually driving your portfolio's performance. Always keep in mind that the market is a mechanism for pricing these various risks, and the return you seek is directly proportional to your ability to manage both the systemic environment and the internal integrity of your chosen investments. We will revisit these concepts as we evaluate individual security valuation throughout the rest of your study process. I look forward to our next session together. Welcome back. In this chapter, we will master the quantitative pillars of modern capital market theory and the core hypotheses of market efficiency that govern portfolio management. To build a robust investment strategy, we must first master the mathematical tools that define how we measure risk and reward in a clinical, objective fashion. One of the most critical elements in your toolkit is the Capital Asset Pricing Model, or CAPM, which provides a theoretical framework for calculating the required rate of return on an investment based on its sensitivity to market movements. The model relies on the risk-free rate, which is typically represented by the yield on government securities, combined with the security's beta multiplied by the expected market risk premium. This formula essentially forces us to acknowledge that an investor must be compensated for taking on additional non-diversifiable risk that exists beyond the reach of simple asset allocation. If a stock or portfolio has a beta of 1, it is expected to perform in lockstep with the broader market, while a beta exceeding 1 signifies higher volatility and therefore demands a higher expected return. Understanding these mechanics is not just about passing an exam, but about developing the intuition necessary to evaluate whether a specific risk premium adequately compensates an investor for their exposure. Once we establish our required rates of return, we turn our attention toward performance evaluation metrics, specifically alpha and the Sharpe ratio. Alpha provides a measure of a portfolio manager's added value, representing the excess return earned above the benchmark that would be predicted by the CAPM. A positive alpha indicates that the manager has successfully generated returns through security selection or tactical timing, effectively beating the market on a risk-adjusted basis. This stands in contrast to the Sharpe ratio, which evaluates the return earned in excess of the risk-free rate per unit of total risk, measured by standard deviation. By dividing the excess return by the standard deviation of the portfolio, we create a standardized scalar that allows for a direct comparison between vastly different investment vehicles. These metrics are fundamental because they strip away the facade of nominal returns and expose the true efficiency of a management strategy. You will find that these calculations often serve as the primary benchmarks for assessing institutional performance in a variety of regulatory contexts. The final conceptual layer we must address is the efficient market hypothesis, or EMH, which serves as the intellectual cornerstone for the debate between active and passive management. The hypothesis exists in 3 distinct forms, each making progressively stronger assertions regarding what information is already reflected in current security prices. The weak form argues that historical price and volume data are already fully integrated, rendering technical analysis ineffective for gaining an edge. Moving to the semi-strong form, the theory posits that all publicly available information, including financial statements and news announcements, is rapidly absorbed by the market, thereby neutralizing the benefits of fundamental analysis. Finally, the strong form claims that all information, including private or insider details, is reflected in the price, which leaves active management with no consistent way to generate positive alpha over the long term. As a regulatory professional, you must understand these tiers because they dictate the philosophy behind standard portfolio construction and explain why certain benchmarks are utilized as proxies for market performance. Whether you lean toward the view that markets are generally efficient or believe that temporary mispricings create opportunities for active gains, you must be able to justify your advisory approach using these precise quantitative metrics. The distinction between systemic risk, which is beta sensitive, and unsystematic risk, which can be diversified away, remains a persistent theme throughout your professional practice and the examination itself. By mastering the distinction between beta and alpha, and by internalizing the assumptions underlying the Sharpe ratio, you effectively build a firewall against poor investment logic. We have transitioned from the qualitative aspects of business cycles into the rigid world of mathematical expectation. And this shift is essential for any practitioner aiming to maintain compliance and fiduciary oversight. Keep these formulas clear in your mind, as they provide the underlying logic that prevents subjective decision-making in the portfolios you will manage or oversee. See you in the next lecture. Welcome to our exploration of equity securities, where we break down the fundamental building blocks of corporate ownership. In this chapter, we will master the technical distinctions between various equity classes and the specific rights attached to them. Common stock represents the most basic form of corporate ownership, granting the holder a residual claim on assets and a voice in corporate governance. When you purchase common stock, you are buying a piece of the company's equity, which inherently carries the risk of loss if the business fails to thrive in its market environment. Unlike creditors, common shareholders do not have a contractual right to dividends. These are only distributed at the discretion of the board of directors. Ownership allows for capital appreciation if the enterprise grows, but it is subordinate to all debt and preferred stock in the event of a corporate liquidation. Shareholders typically enjoy voting rights, which empower them to participate in the selection of the board and influence major corporate policy decisions. These rights are fundamental to the equity model, yet they vary significantly depending on whether the corporation utilizes statutory or cumulative voting structures. Investors must recognize that while common stock offers the highest potential for long-term growth, it simultaneously exposes the holder to the most extreme volatility among the company's capital stack components. Understanding these nuances is essential for any professional assessing the risk-reward profile of an equity portfolio. Preferred stock occupies an interesting space between equity and debt, as it often behaves more like a fixed income instrument while retaining its status as part of the company's equity capital. These securities typically pay a fixed dividend, calculated as a percentage of the par value, which offers a more consistent income stream than common dividends. When we categorize preferred shares, we look for key features such as cumulative and non-cumulative status, where cumulative preferred shares require the company to pay any missed dividends before any payment can be made to common shareholders. Some preferred issues are even participative, potentially offering the investor a share in additional dividends if corporate earnings exceed a certain threshold. Convertible preferred stock adds further complexity by allowing the investor the option to convert their position into a fixed number of common shares, effectively linking the fixed income return to the upside potential of the company's growth. Because these shares behave like bonds due to their fixed payouts, they are generally more sensitive to fluctuations in market interest rates. Investors considering these instruments should weigh the benefit of enhanced income stability against the potential for decreased capital appreciation compared to common stock. Corporate governance revolves largely around how voting rights are exercised, and the choice between statutory and cumulative voting can significantly alter minority shareholder influence. Under a statutory voting system, a shareholder is granted one vote per share for each vacant seat on the board of directors, which effectively favors major stockholders who can easily control each individual election. Conversely, cumulative voting allows shareholders to combine their total votes and allocate them as they see fit across multiple board candidates, which provides a meaningful tool for minority investors to secure representation. Beyond voting, investors often encounter preemptive rights, which give existing shareholders the authority to maintain their proportional ownership by purchasing new shares before they are offered to the general public. Warrants, meanwhile, represent a different type of access, providing the holder with the right to purchase shares from the issuer at a predetermined price for a specific period of time. These mechanisms are tools that directly impact a shareholder's stake and potential dilution, requiring a disciplined approach to tracking corporate actions. Successfully navigating these rights requires a firm grasp of how they interact with equity valuation and how they shift the balance of power within the corporate structure. Fundamental analysis of equity value frequently relies on quantitative models like the dividend discount model, which estimates the value of a stock based on the present value of its future dividend streams. This approach requires clear assumptions regarding growth rates and the required rate of return. serving as a primary framework for valuation when dividends are predictable. For stocks that do not pay significant dividends, or for those in aggressive growth states, analysts often look toward technical indicators or price-to-earnings ratios to assess market sentiment and fair value. We must also consider the mechanical adjustment to the cost basis that occurs following stock splits, as these actions change the number of shares and the price per share without altering the total market capitalization of the firm. Equity resale regulations, such as those governing restricted and control securities, add another layer of regulatory oversight that impacts the liquidity of an investment. Effectively managing equity requires one to synthesize these technical components with an awareness of dividend distributions and market cycles. By maintaining an objective perspective on these valuation metrics, an advisor can better align client portfolios with specific risk profiles and long-term financial objectives. Join me in our upcoming discussion as we pivot toward debt instruments and fixed income valuation methods. Welcome back. In this lecture, we will perform a rigorous investigation into the structural characteristics, interest behavior, and issuer taxonomy of fixed income securities to build a solid foundation for your exam. Fixed income securities function as formal lending arrangements where an investor provides capital to an issuer in exchange for the promise of periodic interest payments and the return of principal at maturity. From a structural perspective, these instruments are defined by their coupon rate, their maturity date, and their par value. While the concept sounds straightforward, the nuance lies in how different issuers manage these obligations and how the market prices that risk into the creditworthiness of the entity. When we discuss U.S. Treasury obligations, we are looking at the most secure assets in the market, often referred to as risk-free benchmarks. Treasury bills are short-term instruments issued at a discount, while Treasury notes and bonds pay semi-annual interest and have longer maturities. Treasury inflation-protected securities, or TIPS, provide a unique mechanism where the principal is adjusted based on changes in the consumer price index, thereby protecting the investor against purchasing power erosion. Moving into the federal agency space, we encounter instruments that, while not always explicitly backed by the full faith and credit of the U.S. government, carry significant weight in the market. Mortgage-backed pass-through structures represent a distinct category where cash flows from a collection of home mortgages are pooled and distributed to investors. These are inherently different from Treasury securities because they involve prepayment risk, which is the possibility that homeowners will refinance their mortgages if interest rates fall, thereby returning the principal earlier than expected. Understanding this distinction is vital because it shifts the focus from simple interest rate risk to a more complex interplay of economic behaviors and systemic mortgage funding. As you navigate these structures, keep in mind how the nature of the underlying collateral dictates the behavior of the yield that an investor might expect to receive over time. Municipal debt introduces an entirely different regulatory and credit profile rooted in the taxing power of local governments. General obligation bonds are backed by the full taxing authority of the issuing municipality, which means the issuer can theoretically raise taxes to satisfy interest and principal payments. Conversely, revenue bonds are issued to fund discrete income-generating projects such as toll roads, airports, or hospitals, and their repayment depends solely on the revenue generated by these specific entities. This distinction is critical for your analysis because the risk profile of a revenue bond is tied to the success and operational efficiency of the project itself. These bonds often carry tax-advantaged status, typically being exempt from federal income tax and, for residents of the issuing state, often free from state and local taxes as well. Corporate debt encompasses a broader spectrum of risk and control, ranging from secured mortgage bonds to unsecured debentures. Secured bonds are backed by specific physical assets of the corporation, providing the lender with a concrete layer of protection in the event of default. Debentures, by contrast, are unsecured and rely entirely on the general creditworthiness and financial health of the issuing corporation. We also see convertible structures, which inject equity-like characteristics into a debt instrument by allowing the holder to exchange the bond for a specified number of company shares. These instruments create a complex valuation environment because their price reflects both the prevailing interest rates and the performance of the underlying stock. Credit rating agencies play a central role here, as they assign grades that reflect the probability of default based on an investigation of the issuer's balance sheet and cash flow stability. You must also be aware of the sovereign risk attached to foreign bond issuances, which introduces the variables of currency fluctuation and geopolitical instability. When a U.S. investor holds debt denominated in a foreign currency, they are essentially taking a position on the exchange rate between the two countries in addition to the interest rate movement. This adds a layer of volatility that is absent in domestic debt markets, requiring a more cautious approach to risk assessment. Understanding the tax characteristics of these varying debt instruments is paramount, as the tax treatment of interest income can drastically alter the net yield for clients in different tax brackets. A well-constructed portfolio often balances these diverse debt instruments to achieve a target risk-adjusted return that aligns with the client's financial objectives and liquidity needs. Good luck with your study. Welcome back to our technical journey through the mechanics of fixed income. Today, we will dissect bond valuation and the mathematical sensitivities that govern how these instruments behave when market conditions fluctuate. To understand the price of a bond, we must first accept that it is the present value of its future cash flows, discounted at the prevailing market interest rate. When the market rate rises above the bond's stated coupon rate, the security becomes less attractive relative to new issues, forcing its price to drop to a discount. Conversely, if market rates fall below the coupon rate, the bond commands a premium because it pays a higher interest rate than what is currently available on similarly risky new debt. This inverse relationship between price and yield is the fundamental heartbeat of the fixed income market. A bond trading at par has a yield to maturity equal to its current yield and its nominal coupon rate. But this equilibrium is fragile and shifts the moment interest rates move. Managing these fluctuations requires strict attention to the distinction between various yield metrics. While the nominal yield focuses purely on the coupon payment, the yield to maturity accounts for the capital gain or loss realized if the investor holds the bond until its scheduled expiration. The concept of duration serves as our primary gauge for interest rate sensitivity, measuring the weighted average time until an investor receives the cash flows from a bond. Think of duration as the elasticity of a bond's price. A portfolio with high duration will swing violently in value during even modest interest rate tremors. We calculate this sensitivity to understand how a 1% change in yields impacts the overall market value of the debt holding. While a bond's maturity date indicates when the principal returns, duration gives us the operational reality of how the bond actually functions in a living portfolio. If you are managing a client's wealth and expect interest rates to rise, shortening the duration of their bond holdings is the standard tactical response to mitigate price depreciation. Duration acts as a first-order approximation, but it assumes a linear relationship that, as we shall see, is not always perfectly accurate in real-world market scenarios. The math here is robust, designed to provide predictable outcomes in an otherwise uncertain macroeconomic environment. Convexity is the necessary refinement to duration, accounting for the reality that the price-yield curve for most bonds is actually a curve rather than a straight line. As interest rates decline, the price of a bond increases at an accelerating rate because the present value of future cash flows grows increasingly significant. When rates rise, the price decreases, but the rate of depreciation tapers off as the bond approaches a lower price floor. Convexity mathematically reflects this curvature, providing a more precise estimation of price volatility than duration alone can offer. Portfolio managers favor bonds with higher convexity because they perform better than expected when rates fall and lose less than expected when rates rise. Ignoring convexity effectively means ignoring the structural limitations of simple duration, which can lead to significant miscalculations in risk assessment. It is a subtle but vital component for any advisor tasked with providing a technical analysis of their client's debt allocation. We must also contend with reinvestment risk and the structural boundaries imposed by call provisions. Reinvestment risk is the danger that an investor will be forced to reinvest principal or coupon payments at a lower rate than the original investment, a phenomenon that occurs frequently during periods of falling interest rates. Bonds with call features exacerbate this risk because issuers will almost invariably call the debt precisely when interest rates have fallen and it has become cheaper for them to refinance. This creates a ceiling on the bond's price, as the market anticipates the probability that the security will be redeemed long before it reaches its maturity date. Therefore, Yield to call is often a more accurate measure of performance than yield to maturity for callable bonds nearing their call date. Credit spreads further complicate this picture, representing the additional yield an investor demands for the risk of default compared to a risk-free government benchmark. Monitoring these spreads allows us to quantify the market's assessment of an issuer's solvency in real time. See you in the next lecture. Welcome back. In this lecture, we will explore the structural complexities and cost mechanisms inherent in pooled investment vehicles, specifically focusing on how mutual funds and ETFs function within a portfolio. When we approach the topic of pooled investments, we are essentially looking at collective vehicles that allow individual investors to benefit from professional management and diversification. The primary distinction between these vehicles often rests on their capitalization and how their shares are priced and traded in the secondary market. An open-end investment company, commonly known as a mutual fund, issues redeemable shares that are bought and sold based on their net asset value. This net asset value is calculated by taking the total market value of the fund's assets, subtracting its liabilities, and dividing that amount by the total number of outstanding shares. Because mutual funds are redeemable, the investor sells their shares directly back to the fund rather than to other market participants. This process relies on forward pricing, meaning that any purchase or redemption order is executed at the next calculated net asset value, usually at the close of the market. In contrast, closed-end funds operate with a fixed capitalization, meaning they offer a specific number of shares through an initial public offering, after which those shares trade on an exchange. Because they trade like stocks, their market price is determined by supply and demand, which may lead to premiums or discounts relative to their underlying net asset value. Unit investment trusts also differ in structure as they typically hold a fixed portfolio of securities meant to be held until a specific termination date. These trusts do not have active management, which stands in stark contrast to the dynamic rebalancing seen in mutual funds or the index replication strategies employed by many exchange-traded funds. Understanding these structures is crucial because the structural architecture dictates how an investor enters or exits the position and how transparent the pricing becomes during the holding period. Fee structures are an immutable component of your analysis when evaluating the cost of ownership for these vehicles. Mutual funds typically utilize a combination of front-end loads, which act as a commission taken from the initial investment, and back-end charges, often referred to as contingent deferred sales charges. These back-end fees are designed to discourage short-term trading by imposing a penalty if the investor withdraws their capital before a predefined period expires. Beyond these transactional costs, you must account for 12b-1 fees, which are annual operational charges intended to cover marketing and distribution expenses. These fees affect the net return delivered to the investor and are explicitly laid out in the fund's prospectus. As an advisor, you are responsible for discerning how these overlapping costs impact the long-term viability of a recommended investment strategy for your clients. Exchange-traded funds introduce intraday trading dynamics, allowing investors to buy and sell shares throughout the market day at current market prices. Unlike the forward pricing seen in mutual funds, ETFs often seek to track a specific index, which brings the concept of tracking error into our analytical focus. Tracking error refers to the divergence between the price behavior of the ETF and the performance of the underlying benchmark index it attempts to replicate. While ETFs are generally more tax efficient than mutual funds due to their creation and redemption process in kind, they are not immune to market volatility or the risks associated with index replication. When analyzing share class attributes, you must also recognize that different funds offer variable fee structures based on the size of the initial investment or the type of entity, which necessitates a granular review of the expense ratios associated with each specific class. Finally, you should be aware of the historical capital gain distribution rules that govern how tax liabilities are passed through to the investor. When a fund sells securities at a profit, those gains must be distributed to shareholders who are then responsible for the tax implications regardless of whether they have sold their own shares. This adds a layer of complexity to the timing of an investment, as investors might purchase into a fund just before a significant distribution, effectively paying taxes on gains they did not participate in generating. By synthesizing these concepts from the structural differences between closed-end and open-end funds to the nuances of internal fee schedules and tax distributions, you gain the comprehensive oversight required to manage pooled vehicle portfolios effectively. This systematic approach ensures that the advice provided is both structurally sound and economically aligned with the client's financial profile. See you in the next lecture. Welcome to this module, where we will navigate the complexities of derivatives, alternative assets, and insurance-linked products. Understanding these vehicles is essential for providing holistic investment advice, as they often serve specialized roles in hedging, income generation, or risk management. We begin our exploration with derivatives, which are financial contracts deriving their value from an underlying asset. Standard equity options function as a cornerstone here, specifically focusing on the rights and obligations of both buyers and sellers. When you write a covered call, you are essentially selling an option against a long position in the underlying stock, thereby collecting a premium in exchange for capping your potential upside. Conversely, a long put serves as a defensive hedge, providing a floor for your portfolio by granting the right to sell the asset at a predetermined strike price. It is important to distinguish these from futures contracts, which represent a binding obligation to buy or sell an asset at a specified price on a future date, unlike an option which provides choice. Forward contracts, while similar in function to futures, are typically customized, private agreements between two parties rather than standardized contracts traded on an exchange. Managing these instruments requires a firm grasp on the mathematical reality that price discovery hinges on the cost of carry and interest rate differentials between the spot and forward markets. Turning to alternative assets, we must address the characteristics that differentiate these from traditional stocks and bonds. Real estate investment trusts are perhaps the most common, offering a liquid structure to participate in large-scale income-producing real estate ventures while maintaining specific distribution requirements for tax efficiencies. Master limited partnerships operate primarily in energy infrastructure, blending the tax benefits of a partnership with the liquidity of exchange-traded securities. When considering private equity or hedge funds, the primary distinctions involve their limited liquidity, high barriers to entry, and complex fee structures that often include performance-based incentives. Exchange-traded notes represent another distinct category, as they are essentially debt instruments issued by a bank that promise to pay the return of a specific index rather than an ownership interest in a basket of securities. Finally, viatical settlements add another layer of complexity, where an investor purchases the rights to a policy owner's life insurance payout, illustrating the intersection of mortality risk and alternative capital. The insurance segment of our study centers on products that fuse investment mechanisms with traditional risk transfer. Variable annuities allow owners to invest their premiums in a separate account, which functions much like a mutual fund, providing the potential for tax-deferred growth while exposing the investor to market risk. These products often include mortality and expense charges, which compensate the insurer for the insurance-related risks and administrative costs associated with the contract. Fixed index annuities are structurally different, as they tie the contract's interest crediting rate to the performance of a market index, while typically providing some form of protection against downside market performance. Variable life insurance contracts further blend these concepts, providing a death benefit while allowing the policyholder to direct the cash value into various subaccounts. Regulatory scrutiny is particularly high here, as the complexity of these assets demands clear disclosure of fees, surrender charges, and the specific terms of the insurance guarantees involved. See you in our next session on cash equivalents. Welcome back. Let us discuss how money market instruments function as the bedrock of cash management and liquidity preservation. In this session, we investigate the specific characteristics of cash equivalents that prioritize the preservation of capital above total return. These instruments are inherently short-term in nature, typically maturing in less than 1 year, which limits their exposure to the volatility inherent in longer-duration fixed income assets. When an investment advisor recommends these products, the primary objective is almost always to maintain immediate liquidity while mitigating interest rate risk. You will observe that these instruments provide a stable outlet for parked capital, yet they demand a nuanced understanding of their underlying credit quality and redemption structures. Because clients often view these as risk-free, it is our responsibility to delineate the differences between insured bank products and market-based securities. By the end of this discussion, you'll be able to distinguish between instruments that are backed by federal agencies and those that rely entirely on the creditworthiness of corporate or institutional issuers. Money market mutual funds represent one of the most common vehicles for cash management, specifically designed to maintain a stable net asset value, or NAV, of $1 per share. To achieve this, these funds invest exclusively in high-quality, short-term debt obligations, such as treasury bills or commercial paper with very near-term maturities. The operational goal is to ensure that the fund's share price does not fluctuate, allowing investors to treat their holdings as a liquid cash equivalent. However, you must be aware that while these funds aim for a constant NAV, they are not guaranteed, and in extreme market stress, they can technically break the buck. Portfolio maturity parameters are strictly regulated, as these funds must adhere to weighted average maturity limits to ensure that the underlying assets remain hyperliquid. Effectively, these funds operate as a proxy for a bank account, offering market-competitive yields without locking capital into long-term maturity schedules. Bank-issued instruments present a distinct landscape, primarily because of the protection afforded by the Federal Deposit Insurance Corporation. Demand deposit accounts are the quintessential form of liquidity, providing the investor with the ability to withdraw funds at will without any meaningful penalty or loss of value. When we consider high-yield certificates of deposit, we are looking at instruments that offer a slightly higher return in exchange for a fixed time commitment. Unlike the money market funds we just discussed, these certificates represent a direct liability of the issuing bank, which is why FDIC insurance is the defining feature of the investment. If a client is concerned about the absolute safety of their principal, the insurance limits provided by the FDIC are the cornerstone of their risk management strategy. You should recognize that these instruments, while insulated from market risks, are essentially fixed income products that lack the dynamic liquidity of a standard money market fund or a treasury-backed instrument. Turning our attention to non-bank market instruments, we begin with commercial paper, which is an unsecured, short-term promissory note issued by corporations to finance day-to-day operations. Because these papers are not backed by collateral, they are issued primarily by firms with high credit ratings, making them a staple in high-quality institutional portfolios. Bankers' acceptances serve a different purpose, as they facilitate global trade by functioning as a time draft drawn on a bank to pay for specific goods or services. These instruments are effectively guaranteed by the bank, which adds a layer of security that traditional commercial paper lacks during international transactions. Finally, we must understand repurchase agreements, commonly referred to as repos, where one party sells securities to another with a simultaneous agreement to buy them back at a specified price. Repos are highly critical in the institutional space for providing short-term liquidity, and their structural integrity relies on the quality of the collateral sold during the initial transaction. See you in the next lecture. Welcome back. In this lecture, we begin a new chapter focused on the essential methodology for constructing legally compliant and accurate customer investment profiles. Building a robust investment plan starts with a rigorous data collection process that translates a client's life into measurable financial inputs. You cannot expect to provide sound fiduciary advice if your initial information is incomplete or anecdotal. Think of this process as establishing the technical constraints of a system. If the inputs regarding income, expenditure, and assets are faulty, the output will inevitably drift from the client's actual goals. We must systematically extract quantitative parameters, such as current annual income, household expenditure patterns, and existing security portfolios. Furthermore, an accurate balance sheet requires a comprehensive audit of insurance coverage levels to determine if the client is adequately protected against unexpected liabilities. Without this granular data, your risk assessments lack the mathematical grounding required by regulatory expectations. Compliance is not just about checking boxes, but about proving you have performed the necessary due diligence on the client's financial reality. Beyond the liquid assets and debts, you must analyze the client's tax obligations and their current tax bracket, as these factors fundamentally influence investment selection. A client in a high marginal tax bracket requires entirely different strategies regarding municipal bonds or tax-advantaged accounts compared to someone with lower taxable income. We also need to document non-financial attributes, including the client's historical investment experience and their stated risk tolerance thresholds. While risk tolerance is often subjective, It must be mapped against objective parameters like time horizon and liquidity needs to be actionable. Family demographics also play a crucial role here, as they often dictate the duration of the investment horizon and the necessity of capital preservation. When you build a profile, you are essentially defining the boundary conditions within which your advisory service must operate. Identifying specific constraints requires us to look further into the future to account for near-term capital expenditures and multi-generational wealth transfer intentions. If a client expects a significant cash outflow in the next 18 months for a major purchase or a business transition, that amount must be partitioned away from the volatile portions of their security portfolio. Similarly, if there is an intent to pass assets to heirs, estate considerations begin to influence the structure of the investment vehicle itself. These constraints serve as an anchor for the portfolio. They prevent the temptation to chase market alpha at the expense of necessary liquidity. A well-constructed profile effectively filters out irrelevant market noise, focusing the client on the assets that actually align with their long-term objectives. You should view this data gathering phase as a technical design activity where you must document every requirement so that the resulting investment policy is defensible and audit ready. See you in the next lecture. Welcome to this discussion on portfolio management, where we explore the structural frameworks used to organize and maintain client investments according to long-term goals and short-term market fluctuations. Asset allocation is the process of distributing a portfolio's assets across different categories, such as stocks, bonds, and cash equivalents, to balance risk and reward based on an individual investor's goals, risk tolerance, and time horizon. Strategic asset allocation is a long-term approach that sets target allocations for various asset classes and rebalances back to these targets periodically. The primary objective here is to maintain a consistent risk profile over many years. Because life and market conditions change, the act of rebalancing is essentially a disciplined mechanism to sell assets that have outperformed and increase exposure to those that have underperformed, keeping the original risk-return parameters intact. This strategy assumes that market returns are difficult to predict over short periods, so it prioritizes sticking to a plan over trying to time the market maneuvers. In contrast, tactical asset allocation offers a more flexible, active component that allows an investment advisor to temporarily deviate from the strategic allocation to take advantage of perceived market conditions. Think of this as an intentional shift where the advisor believes they can capture additional returns by overweighting a specific sector or asset class that they expect to perform better in the short run. This requires a higher degree of monitoring and market insight compared to a purely strategic approach. While it provides the potential for higher returns, it also introduces the risk of human error in timing the market or failing to recognize when a tactical shift should be reverted. Thus, the distinction lies in the commitment. Strategic is about adherence to a structure, while tactical is about exploiting opportunities within a set mandate. When we look at portfolio construction, we often distinguish between active and passive management styles. Active management is predicated on the belief that a skilled manager can select securities that outperform the broader market, thereby generating what we call alpha. These managers utilize research, data analysis, and their judgment to pick specific stocks or bonds, which involves higher transaction costs and typically higher fees. Conversely, passive management, often implemented through index funds or exchange-traded funds, seeks to replicate the performance of a specific market index rather than beat it. The core philosophy here is that markets are efficient enough that the additional cost of active management often cancels out any gains the manager might have achieved, making low-cost passive tracking a superior choice for many long-term investors. One of the most foundational techniques in this space is dollar cost averaging, which acts as a mechanism to mitigate the risk of market timing by investing a fixed dollar amount at regular intervals. By purchasing more shares when prices are low and fewer shares when prices are high, the investor lowers the average cost of their holdings over time. This removes the emotional component of deciding when to enter the market, which is a major hurdle for many individual investors. It is particularly effective for those engaged in long-term wealth accumulation who do not have the time or inclination to analyze daily market price movements. When coupled with a disciplined investment style, such as focusing on growth or value, Dollar cost averaging provides a steady, low-friction path to building an equity position. Growth versus value represents the classic dichotomy in equity selection strategies. Growth investing focuses on companies that exhibit significant potential for earnings expansion, often at prices that may seem expensive relative to current earnings or book value. These firms typically reinvest their profits back into the company rather than paying them out as dividends. Value investing, on the other hand, seeks out stocks that the market has undervalued, perhaps due to temporary bad news or general investor apathy. Value investors look for strong fundamentals, like solid balance sheets and reliable dividends, believing that the market will eventually recognize the true, higher intrinsic value of these companies. These two styles often perform differently, depending on the economic cycle, which makes them useful for diversifying an overall portfolio. Market capitalization segmentation further refines our understanding of how portfolios are built across the large, mid, and small cap spectrums. Large cap companies are generally well established with stable revenue streams, offering lower volatility but often more modest growth prospects. Small cap stocks offer higher growth potential but come with increased susceptibility to market downturns and higher volatility, reflecting the smaller firms' limited financial buffers. By incorporating sector rotation, an advisor can shift focus between these segments or specific industries based on their outlook for the business cycle. This rotation is a refined, active technique that requires a coherent understanding of macroeconomic indicators to time the movement between sectors successfully. Ultimately, the choice among these strategies depends on the client's specific financial needs and the advisor's professional judgment regarding market efficiency and risk management. No single style is universally superior for every client because each brings a different set of trade-offs regarding risk, cost, and expected return. When advising a client, you are creating a system that balances these factors to ensure the portfolio remains robust regardless of the market environment. The goal is to harmonize the client's psychological tolerance for risk with the technical requirements of the market. It is through this balanced application of theory that we guide clients toward their long-term financial objectives. I look forward to discussing how these strategies function within different legal entity structures in our next meeting. Welcome back. In this lesson, we will examine the structural nuances of various client entities, focusing on the legal and fiduciary frameworks governing trusts, estates, and organizational accounts. To understand the scope of advisory work, you must first distinguish between the legal capacities of different client entities. Individual accounts are the simplest form of ownership, where a single person maintains total authority over the assets. When we move into joint ownership, the stakes involve how responsibility and title transfer upon death. Joint tenants with rights of survivorship, or JTWROs, stipulates that all owners hold an equal, undivided interest in the account. Crucially, when one tenant passes away, the entire interest transfers automatically to the surviving tenant, bypassing probate. Conversely, tenants in common, or TIC, allows for unequal ownership percentages, and the deceased share passes to their estate rather than the other owner. These distinctions are vital because they define the scope of your fiduciary duty when executing orders or gathering client instructions. Corporate and organizational accounts require a different approach, as you are not dealing with a natural person, but a legal entity. A sole proprietorship, for example, is essentially an extension of the individual, meaning the owner remains personally liable for all business debts. When managing assets for a nonprofit foundation, the governing documents, often the charter or bylaws, must dictate your investment policy statement. Your primary task here is to ensure that the liquidity and risk profile of the portfolio align with the foundation's mandate and the constraints imposed by their board. Unlike a personal account, a nonprofit entity often requires a board-approved investment policy, and your advisory activities must remain strictly compliant with these static governance rules. Governance here is not merely a suggestion, but a contractual constraint on the advisory relationship. Trust instruments introduce a complex layer of fiduciary oversight, where the interests of the grantor, the trustee, and the beneficiaries must be balanced. A grantor establishes the trust by transferring assets, while the trustee manages those assets for the benefit defined in the legal document. You must understand the difference between simple and complex trusts, as this dictates how income tax obligations are handled at the entity level versus the beneficiary level. In a simple trust, all income must be distributed annually, whereas a complex trust allows the trustee to retain income or distribute principal based on specific conditions. Regarding fiduciary duties, you are bound by the Uniform Prudent Investor Act, which shifts the focus from individual security performance to the overall portfolio risk and return within the context of the entire trust estate. Prudence requires diversification, and you cannot simply rely on the historical performance of high-yield assets to satisfy the beneficiary's needs. Estate administration concerns the final management and distribution of assets following the death of an account holder. When you work with an executor or administrator, your mandate is to protect the asset pool until the legal transfer is complete. This process involves strict adherence to the guidance provided by the probate court or, in the case of a revocable trust, the successor trustee's mandate. The Uniform Transfers to Minors Act provides the framework for custodial accounts, which are irrevocable gifts transferred to a minor where the custodian manages the assets until the age of majority. You must remember that these assets belong legally to the minor, even if the custodian manages them, meaning the investments must be managed with a focus on the minor's long-term financial interest. The fiduciary standard remains absolute throughout these processes, even when emotional factors complicate the environment for the remaining parties. Every decision you make for these distinct entities must be documented and defended against the standard of what a prudent professional would do under similar circumstances. Governance is not an administrative burden, but the bedrock of your compliance framework. Whether you are dealing with a foundation or an individual's trust, the investment plan serves as the objective measure of your adherence to client objectives. Always ensure that the account documentation clearly identifies the authorized signers and the intended beneficiary structures, as these are the primary points of audit in any regulatory review. By mastering these distinctions, you position yourself to navigate the complexity of advisory work with the necessary precision to pass the exam. See you in the next lecture. Welcome back. In this lesson, we will examine the mechanics of taxation for individual portfolios and the structured rules governing the transfer of wealth across generations. Understanding how the IRS views various income streams is foundational for any investment advisor. We start with ordinary income, which includes interest payments, salary, and short-term capital gains, all taxed at your client's marginal tax rate. Contrast this with long-term capital gains, which apply if an asset is held for more than 1 year and are typically subject to more favorable preferential tax rates. Netting these gains and losses is a mechanical exercise where you first offset short-term losses against short-term gains, then long-term losses against long-term gains, and finally, net the remainders. If a net loss exists, taxpayers can claim up to $3,000 against ordinary income annually, with any excess carried forward indefinitely. It is vital to note the wash sale rule, which prohibits claiming a loss on a security if a substantially identical position is purchased within 30 days before or after the sale. Violating this rule essentially denies the tax deduction, forcing the disallowed loss to be added to the cost basis of the newly acquired security, thereby pushing the tax burden into the future. For clients seeking tax-advantaged income, we must look at the specific characteristics of bond interest. Interest from municipal bonds is generally exempt from federal income tax, though it may be subject to state or local taxes depending on the investor's residency, whereas corporate bond interest is fully taxable at the federal, state, and local levels. This necessitates calculating the tax equivalent yield to determine whether a municipal bond truly offers better value than a taxable corporate alternative. We also encounter the alternative minimum tax, a parallel tax system designed to ensure that wealthy individuals who utilize specific tax preferences still pay a baseline amount. Triggers for this tax include excessive private activity bond interest or certain incentive stock option exercises that do not appear on a standard tax return. As advisors, we often facilitate tax swapping, where positions with unrealized losses are sold to offset gains in other parts of the portfolio. This strategy helps optimize the overall tax liability without fundamentally altering the portfolio's long-term asset allocation objectives. Wealth transfer involves its own set of distinct calculations, primarily focusing on the step-up in basis and gift tax guidelines. When a beneficiary inherits securities, the cost basis is typically adjusted to the fair market value at the time of the donor's death, which effectively eliminates the tax liability on any appreciation that occurred during the original owner's lifetime. Conversely, when a gift is made, the recipient assumes the donor's original cost basis, known as carrying over the basis. We must monitor the annual gift tax exclusion, which allows individuals to transfer a specific amount of assets per recipient per year without eroding their lifetime gift tax exemption. If a gift exceeds the annual threshold, the donor must file a gift tax return to report the excess against their lifetime federal estate tax exclusion. Estate taxes are calculated based on the total value of the decedent's gross estate, less allowable deductions such as funeral expenses, debts, and charitable bequests. Navigating these requirements demands meticulous record-keeping and a clear understanding of the interplay between federal gift and estate tax brackets. See you in the next lecture. Welcome back. In this chapter, we explore the intricate regulatory framework governing tax-advantaged retirement accounts, employer-sponsored plans, and the mandates imposed by ERISA. Retirement planning is the cornerstone of a fiduciary practice. Yet many advisors approach it with a superficial understanding of the underlying statutory requirements. This chapter provides a rigorous examination of how individual and corporate retirement vehicles function under the oversight of the Internal Revenue Service and the Department of Labor. We will strip away the common misconceptions about contribution limits and early withdrawal penalties to reveal the underlying mechanic of how these accounts are taxed and regulated. By mastering these concepts, you will move beyond simple advice and provide your clients with historically informed, legally sound strategies. This is the difference between being a generic salesperson and becoming a true fiduciary partner for your clients. We begin with individual retirement configurations, specifically traditional and Roth IRAs. At the core of the traditional IRA is a tax-deferred growth mechanism, where contributions may be deductible depending on the client's adjusted gross income and whether they are active participants in an employer plan. The IRS mandates specific contribution boundaries that adjust annually for inflation, and it is vital to track these shifts to avoid excess contribution penalties. Withdrawals taken before the age of 59.5 typically incur a 10% penalty on top of ordinary income taxes, though exceptions exist for specific circumstances like qualified higher education expenses or first-time home purchases. Conversely, the Roth IRA functions as a post-tax vehicle, meaning contributions are made with after-tax dollars, providing the benefit of tax-free growth and qualified distributions. It is worth noting that Roth IRAs do not require mandatory distributions during the owner's lifetime, which serves as a powerful tool for estate planning efficiency. Understanding the income phase-out limits for Roth eligibility is essential, as these parameters dictate whether a high-income client can contribute directly or must look to alternative strategies. When we shift our focus to corporate retirement coverages, the regulatory landscape becomes considerably more complex due to the Employee Retirement Income Security Act, commonly known as ERISA. Defined benefit plans represent a promise from the employer to pay a specific benefit at retirement, requiring complex actuarial calculations to ensure the plan remains fully funded over time. In contrast, defined contribution plans, such as 401k frameworks and 403b tax-sheltered annuities, shift the investment responsibility and the longevity risk toward the employee. A critical element here is the non-qualified deferred compensation structure, which does not receive the same ERISA protections and tax advantages, often serving as a tool for executive retention. These plans are designed to bypass the non-discrimination testing required for qualified plans, meaning they are primarily reserved for highly compensated employees. As an advisor, you must be able to distinguish between qualified plans that fall under ERISA's strict fiduciary standards and non-qualified arrangements that operate under different contractual frameworks. ERISA serves as the protective shield for employees, imposing stringent fiduciary standards on plan sponsors and their advisors. At the heart of these mandates is the requirement that all fiduciary actions must be taken solely in the interest of plan participants and their beneficiaries, adhering to the prudent person standard. Plan sponsors are required to create, document, and maintain an investment policy statement that outlines the objective criteria for selecting and monitoring the plan's investment options. We must pay close attention to vesting schedules, which determine the rate at which an employee gains non-forfeitable rights to the employer's contributions. Furthermore, ERISA strictly prohibits self-dealing or transactions between the plan and parties in interest that could result in improper financial gain. These prohibited transaction rules are designed to prevent conflicts of interest that could compromise the integrity of the retirement assets held in trust. A plan sponsor who ignores these obligations exposes themselves and the firm to significant liability, emphasizing why the role of a knowledgeable, neutral third-party advisor is so crucial to the operation of any retirement plan. See you in our next session. Welcome back. In this lesson, we are going to explore specialized account architectures that facilitate education savings, health-related funding, and essential disability protections. Section 529, plans represent the primary vehicle for education savings, and they essentially function as state-sponsored investment accounts that offer distinct tax advantages to the account owner and the beneficiary. Broadly, these plans exist in two variants: prepaid tuition plans and college savings programs. Prepaid tuition plans allow individuals to lock in current tuition rates at participating institutions, effectively acting as a hedge against future inflation in college costs. Conversely, college savings programs are defined as investment accounts where the assets grow on a tax-deferred basis, and distributions remain federally income tax-free as long as they are utilized for qualified higher education expenses. While there is no federal limit on the total contributions you can make into a 529 plan, individual states do establish aggregate funding caps, and exceeding those limits can trigger gift tax consequences if the contributions surpass the annual per donor exclusion. It is also important to note that many states offer income tax deductions or credits for contributions made to their specific plans, which makes them a powerful tool for residents looking to optimize their tax liabilities while systematically saving for the future. When we shift our focus to the Coverdell Education Savings Account, we encounter a different set of constraints and capabilities that distinguish it from the 529 framework. A Coverdell account allows for tax-deferred growth and tax-free withdrawals, provided the funds cover qualified education expenses. But unlike the 529 plan, these have strict annual contribution caps. Specifically, the annual contribution is limited to $2,000 per beneficiary across all accounts, and eligibility to contribute is phased out for donors based on their modified adjusted gross income. One unique feature of the Coverdell is that these funds can be used not only for higher education costs, but also for qualified K-12 expenses, such as tuition, books, and uniforms at public, private, or religious schools. If the beneficiary does not use the funds by the time they reach age 30, the account must generally be distributed or rolled over to a family member to avoid tax penalties. This makes the Coverdell an excellent, though limited capacity, instrument for families targeting early education expenses alongside later college funding. Health savings accounts, or HSAs, are frequently misunderstood as mere convenience vehicles, but they are uniquely powerful due to their triple tax advantage status. Contributions to an HSA are made pre-tax or are tax-deductible. The assets grow without the immediate burden of taxation, and distributions for qualified medical expenses are entirely tax-free. To qualify for an HSA, an individual must be enrolled in a high-deductible health plan, which serves as a mechanism to shift the burden of routine health costs to the user while protecting against catastrophic medical events. Because the funds carry over from year to year regardless of spending, an HSA can function as a long-term investment vehicle for healthcare in retirement, provided the account owner manages the investment portfolio within the account prudently. The statutory structure incentivizes the accumulation of assets to cover health costs that insurance plans might otherwise ignore, making it a critical component of a comprehensive financial plan for many clients. Regarding disability planning, Section 529A, commonly known as the ABLE account, provides a tax-advantaged savings mechanism for individuals who experience the onset of disability before reaching the age of 26. Contributions are made using post-tax dollars, but investment growth is tax-deferred, and withdrawals for qualified disability-related expenses stay tax-free, which ensures that those with disabilities can save money without jeopardizing their eligibility for essential government programs like supplemental security income or Medicaid. These accounts recognize that medical and daily living expenses for individuals with disabilities can be significant and ongoing, providing a framework to mitigate that financial strain. Separately, from an estate planning perspective, advisors must understand how to manage account ownership via registrations such as transfer on death or pay on death. These designations allow for the non-probate transfer of assets to a named beneficiary upon the death of the original owner, which effectively simplifies the transfer process and minimizes the administrative costs often associated with a formal probate proceeding. Successfully navigating the nuances of these specialized accounts ensures that your clients can optimize their tax strategies while meeting their long-term financial goals. See you in the next lecture. Welcome to our deep dive into the Uniform Securities Act, the cornerstone of state-level regulation you must master for this exam. In this section, we move away from market theory and delve into the legal scaffolding that governs investment advisory activities at the state level. The Uniform Securities Act serves as a model framework, which individual states adopt or modify to create their own blue sky laws, intended to protect investors within their specific jurisdictions. Understanding this act is not just about memorizing statutes. It is about grasping the operational boundaries imposed on every investment advisor. We will dissect the granular powers granted to the state securities administrator and establish how these authorities interact with the securities industry. This is where your understanding of compliance and legal responsibility begins to take a professional shape. The state securities administrator is the primary regulatory official tasked with enforcing the provisions of the Uniform Securities Act within a given state. Their power is broad and intentionally designed to be flexible, allowing them to adapt to changing market conditions or specific instances of consumer harm. One of the most critical aspects of their role is the authority to issue administrative orders, which can range from denying or revoking a registration to imposing censures based on the findings of an investigation. These administrators also possess significant investigative authority, meaning they can conduct inquiries even when there is no specific complaint, provided they have a reason to believe a violation of the law is occurring or is about to occur. This investigative power includes the ability to issue subpoenas, compelling witnesses to testify, or requiring firms to produce documentation. Failure to comply with an administrative subpoena can lead to serious legal consequences, including court-ordered enforcement actions and contempt proceedings. Beyond general investigation, the administrator can exercise emergency powers, most notably through the issuance of a cease and desist order. These orders, which can be issued with or without a prior hearing, demand that a party stop a specific activity immediately, such as the sale of unregistered securities or the practice of fraudulent advisory behavior. While the administrator has this power, the Act also provides a structural check on this potential overreach through the right to appeal. Any person aggrieved by an order of the administrator is entitled to a formal hearing, which must be provided upon written request. If the administrator's final decision remains unsatisfactory to the registrant, the matter can escalate to the judicial system for a formal review. This, however, requires the registrant to observe strict procedural timelines and exhaust the administrative remedies available within the state's regulatory apparatus. The Act also explicitly defines the parameters of anti-fraud jurisdiction, which is perhaps the most critical takeaway for your professional practice. Jurisdiction over a fraudulent act exists if the offer to sell or buy originates in the state, is directed to the state, or is accepted within the state. This creates a wide net that effectively catches any transaction touching a state's borders regardless of where the parties are physically located. When such a breach occurs, the Act provides distinct avenues for investor recovery through civil liability claims and criminal prosecution. Civil liability often arises from the sale of unregistered securities or failures related to disclosure duties, allowing a client to recover the original purchase price plus interest, legal fees, and court costs, minus any income received from the investment. Criminal liability, by contrast, is reserved for willful violations of the Act, which can result in heavy fines and potential incarceration, depending on the severity and intent behind the offense. Managing your professional risks requires strict adherence to the operational mandates established by the Act, specifically regarding record-keeping and security bonds. Investment advisors must keep accurate, up-to-date records, including correspondence, financial statements, and client contracts, which are subject to inspection by the administrator at any time. The duration of this record retention is usually set by state-specific rules, often paralleling federal requirements to ensure that regulators can reconstruct firm activity if necessary. Furthermore, the administrator may require the posting of a surety bond for advisors who have custody of or discretionary authority over client funds. These bonds provide a financial safety net, ensuring that money is available to satisfy judgments in the event of a successful lawsuit for fraud or other violations of the Act. Staying compliant means ensuring that these administrative requirements are meticulously maintained as a standard operating procedure of your firm. See you in the next lecture. Welcome back to our journey through the regulatory landscape of the Series 65 exam. In this lesson, we will dissect the Investment Advisors Act of 1940 and establish how federal oversight interacts with the broader legislative framework. The Investment Advisors Act of 1940 stands as the primary federal statute governing investment advisors in the United States. Before its enactment, the advisory industry lacked a uniform standard, leading to fragmented and often insufficient protections for investors. This historical context is vital because the Act is designed primarily for investor protection through mandated disclosure and fiduciary obligations. Unlike the Securities Act of 1933 or the Securities Exchange Act of 1934, which focus respectively on the issuance and trading of securities, the 1940 Act focuses squarely on the professional activities of those who provide advice for compensation. Understanding this distinction is fundamental, as it defines the scope of federal jurisdiction versus traditional state-level oversight. The Act effectively created the legal definition of an investment advisor, an entity that provides advice on securities for compensation as part of a regular business. By establishing these boundaries, the SEC gained the authority to maintain a registry of practitioners, thereby creating a transparent framework where advisors are held to a clear, actionable standard. One of the most complex areas of your study will be the National Securities Markets Improvement Act of 1996, commonly referred to as NSMEI. Before NSMEI, firms were often required to register with both federal authorities and every individual state in which they operated, creating a redundant and expensive regulatory burden. NSIA effectively bifurcated the oversight responsibilities between the SEC and state regulators based primarily on the size of the assets under management. Under this regime, the SEC claims jurisdiction over larger advisors identified as federally covered advisors, while state regulators retain authority over smaller firms. This division of labor is not merely administrative. It is designed to ensure that federal resources are focused on firms with significant national impact, while state regulators maintain closer proximity to local advisory activities. The thresholds for this classification are dynamic and require precise attention during the exam, especially regarding how an advisor transitions between these two tiers. When we analyze the threshold for federal registration, we must account for the assets under management, or AUM, which serves as the primary metric for classification. Generally, an investment advisor with $100 million or more in AUM is eligible for SEC registration, while those reaching $110 million or more are generally required to register with the Commission. However, there are specific exceptions, such as advisors to registered mutual funds or those firms operating in states that do not provide an exemption from registration, which would necessitate federal registration regardless of AUM. Even when a firm is federally covered, it is not entirely exempt from state regulatory scrutiny, particularly regarding notice filings. Notice filing requires a federal advisor to submit copies of their SEC filing materials to the state and pay the requisite fees. This allows the state to retain a degree of oversight over who is conducting business within its borders, even if the primary regulatory relationship resides with the SEC. The interaction between these layers of government is enforced through the coordination of state blue sky laws and SEC compliance divisions. Each state has a securities administrator who enforces the Uniform Securities Act, and these administrators maintain the authority to investigate allegations of fraud or unethical practices regardless of an advisor's registration status. When an advisor conducts business at the state level, they must be cognizant that while federal law often preempts state requirements for registration, it never preempts the state's enforcement power to protect its residents from deceitful activity. This creates a dual reality where a firm might be managed from a federal compliance perspective, but remains operationally subject to local examination audits. Maintaining internal compliance infrastructure is therefore not just about satisfying the SEC. It is about demonstrating a readiness to respond to state-led inquiries into standard business practices and ethical compliance. As we move forward, remember that the technicality of these registration thresholds is often tested through practical application scenarios. You should focus on understanding the legislative intent, as this will help you deduce the correct answer when faced with complex questions about AUM fluctuations or multi-state registration requirements. I will see you in the next lesson. Welcome back. In this session, we will examine the regulatory architecture governing investment advisor registration at both the state and federal levels. To understand the professional registration rules for an investment advisor, or IA, we must first determine if an entity meets the legal definition established by the Investment Advisors Act of 1940 and the Uniform Securities Act. The regulators employ a tripartite test to identify an IA, which requires that the entity provides advice about securities, does so as a regular part of its business, and receives compensation for these services. If an entity satisfies all three prongs, it is essentially operating as an investment advisor and must either register or qualify for a specific exemption. We must be precise here because the term compensation is defined broadly, encompassing any economic benefit including advisory fees, commissions, or even indirect payments connected to the advisory relationship. The regularity of the business aspect suggests a recurring activity rather than a one-time encounter, which is why financial planners who hold themselves out to the public are almost invariably classified as investment advisors. This test serves as a foundational boundary, distinguishing genuine professional advice from incidental commentary. When you encounter scenarios on the exam, always verify if all three elements are present before concluding that registration is required. Providing advice on securities for a fee as a regular business is the threshold that triggers the need to navigate the complexities of SEC or state registration protocols. Once the requirement for registration is established, the firm must navigate the registration process, starting with Form ADV, which functions as the primary portal for disclosure. Form ADV is structured into distinct parts that serve different reporting purposes to ensure transparency for both regulators and clients. Part 1A is the primary vehicle for reporting administrative data, including information about the firm's ownership, business practices, disciplinary history, and specifically whether it qualifies for SEC registration or must register with individual states. Part 2A, often referred to as the firm brochure, is where the firm outlines its investment strategies, potential conflicts of interest, and the fee structure in plain English. For firms that manage assets under a wrap fee program, Part 2B, or a similar supplement, is required to provide details about the specific individuals acting as investment advisor representatives. Accuracy here is non-negotiable because any material change in the business, such as a shift in ownership or a change in office location, requires an amendment to the form. Regulators expect firms to update their filings annually within 90 days of the firm's fiscal year-end to confirm the continued accuracy of the information on file. Failing to maintain these filings is not merely a clerical error. It is a regulatory violation that carries significant professional consequences. Registration jurisdiction is primarily determined by the amount of assets under management, commonly known as the AUM threshold. Generally, firms with over $110 million in AUM are required to register with the SEC, while smaller firms are typically mandated to register with the state securities administrators in the states where they have a place of business. However, there is a buffer zone between $100 million and $110 million where registration with the SEC is optional, essentially providing a grace period for firms as they fluctuate around the threshold. Beyond AUM, there are specific exemptions available, most notably for private fund advisors, who are often exempt from full registration provided they meet strict definitions regarding the nature of their clients and the limitations on their marketing activities. It is also important to recognize that, regardless of where a firm registers, they are subject to strict financial requirements if they exercise custody over client funds or securities. Custody occurs when an advisor has the authority to withdraw funds from a client's account or holds client securities. And the regulatory burden in these cases includes higher minimum net capital requirements and annual surprise audits. Advisors must be hyper-vigilant about their financial condition, as any impairment that drops their net capital below the required amount must be reported to the regulator immediately, usually by the next business day. Financial instability triggers a prompt reporting obligation because the safety of client assets is the paramount interest of the regulatory framework. If an advisor realizes that their net capital has fallen below the bare minimum required by their home state or the SEC, they have no discretion to delay reporting. They must file a notice of their financial condition to notify the regulator of the deficit. This serves as a warning system to protect investors from potential insolvency risks that could result in the loss of their managed capital. Along with the financial reporting, advisors must maintain a system of books and records that is robust enough for an auditor to reconstruct every advisory action taken on behalf of a client. These records include copies of all written agreements, ledgers of all transactions, and all communications sent to or received from clients. The duration for which these records must be kept, typically 5 years, with at least 2 of those years held in an easily accessible office location, is a strict mandate, not a guideline. Compliance professionals should view these documentation requirements as the backbone of their ethical obligations, documenting the advice provided and the rationale behind every major portfolio move. By maintaining these records properly, an advisor not only fulfills their legal duty but also creates a roadmap for compliance reviews. Each of these components, from the definition of an advisor to the mechanics of registration and the maintenance of financial health, is designed to ensure that the advisory industry remains transparent and accountable to the public. You will likely see questions that ask you to distinguish between an SEC-registered advisor and a state-registered one, or to identify which part of Form ADV corresponds to a specific disclosure requirement. The key is to keep the criteria clearly separated and to remember that the rules are designed to prevent conflicts and ensure that clients understand exactly what they are paying for and who is managing their money. When you are analyzing a firm's status, always look for the AUM, the nature of the compensation, and the scope of their discretionary powers, as those variables drive the entire regulatory conversation. The registration process is essentially a mechanism to monitor who is in the industry and whether they have the capacity to act as a fiduciary for their clients. Mastering these rules requires you to look beyond the individual terms and see the larger structure of professional accountability that the regulators have built. As you move forward, keep these thresholds and disclosure triggers in mind as you assess the responsibilities of investment advisors in the marketplace. See you in the next lecture. Welcome back. Today we examine the regulatory landscape for investment advisor representatives to understand how state oversight functions within the broader securities framework. An investment advisor representative, or IAR, is defined by the specific functions they perform for an advisory firm. If an individual provides investment advice, manages client portfolios, solicits advisory services, or directly supervises other representatives, they generally fall under the IAR definition. This classification is functional rather than purely title-based, meaning that even if an employee lacks an official title, the nature of their day-to-day engagement with client assets or advisory strategy determines their status. A key distinction exists between an IAR and a clerical employee who performs only ministerial duties. For instance, an assistant who merely processes trades directed by an advisor or schedules appointments is not practicing in an advisory capacity. However, as soon as that individual makes recommendations to a client or evaluates investment strategies, the regulatory requirement for registration is triggered. Understanding this boundary is essential for maintaining compliance with state requirements under the Uniform Securities Act. Registration requirements for an IAR depend largely on whether they are associated with a state-registered or a federally covered advisory firm. Investment advisors managing significant assets, typically those with $110 million or more in assets under management, are classified as federally covered advisors. For these firms, the SEC maintains jurisdiction over the firm itself, but the individual IARs generally must register at the state level in any state where they maintain a place of business. Conversely, if an advisor is registered purely at the state level, the IAR must register in every state where they have a place of business or where they have more than a de minimis number of non-institutional clients. A place of business is defined as any office where the representative provides advisory services, meets with clients, or otherwise holds themselves out as an investment advisor. Identifying the firm's registration status is the first step in determining which specific state forms and notification protocols apply to the representative. The operational workflow for registration centers heavily on the Form U-4, which serves as the primary gateway for employment and licensing. When a person becomes an IAR, the firm must file this form through the Central Registration Depository, or CRD, disclosing employment history, disciplinary records, and potential conflicts of interest. This filing is a continuous responsibility, as the representative is obligated to update the firm whenever material changes occur. such as a change in residential address or a new outside business activity. If the relationship between the firm and the representative ends, the firm is required to submit a Form U-5 within 30 days. This termination filing must specify the reason for departure, as accurate reporting on the U-5 is a fundamental component of the regulatory record that follows the professional throughout their career. Failure to handle these filings with precision can lead to significant administrative sanctions and delays in subsequent employment transitions. Supervision is a central pillar of the regulatory model because firms are held legally accountable for the conduct of their representatives. A firm must establish robust internal controls to monitor representative activity, which involves conducting regular audits of client communications, investment recommendations, and portfolio allocations. This supervisory model requires senior management to evaluate whether the representative is operating within the scope of permitted strategies for their specific client profiles. Supervision is not a passive task. It entails active verification that the representative is not engaging in unauthorized cross-trading, excessive churning of accounts, or undisclosed conflicts of interest. Furthermore, current legal standards require that IARs engage in mandatory continuing education to ensure their knowledge of products, regulations, and ethical standards remains current. By enforcing these rigorous oversight structures, regulators ensure that the public interest remains protected against individual lapses in judgment or integrity. See you in the next lecture. Welcome back. In this lecture, we examine the regulatory framework governing securities registration and the specific exemptions that allow market participants to operate without formal state filing. To understand the registration process, we first start with the statutory definition of a security, which is broadly framed by the Howey test. In legal terms, an investment contract is considered a security if it involves the investment of money in a common enterprise with the expectation of profits derived primarily from the efforts of others. If a product does not meet these criteria, it falls outside the jurisdiction of securities regulators. For example, fixed insurance products, such as traditional whole life policies or guaranteed fixed annuities, are not considered securities because the insurance company assumes the investment risk rather than the policyholder. Conversely, variable annuities are categorized as securities because the owner bears the investment risk, necessitating both product and representative registration. Navigating these distinctions is a fundamental requirement for any professional managing client portfolios, as it dictates the level of oversight and the nature of the disclosures required during a transaction. When a security must be registered at the state level, the Uniform Securities Act provides three distinct pathways: notification, coordination, and qualification. Registration by notification is reserved for well-established, stable companies that meet specific strict financial criteria, such as having a class of equity securities registered with the SEC or being in operation for a significant duration with no history of default. This is the least burdensome method, as it relies heavily on the information already filed with federal regulators. Registration by coordination is the most common path for securities that are also being registered with the SEC under the Securities Act of 1933, allowing the state registration to track the federal filing timeline. Finally, registration by qualification is the most rigorous process, intended for intrastate offerings that do not qualify for federal registration. In this scenario, the issuer acts entirely under state jurisdiction and must provide exhaustive documentation detailing the issuer's business, risk factors, and organizational structure to the state administrator. It is vital to distinguish between exempt securities and exempt transactions, as the two concepts operate under different regulatory logic. An exempt security is inherently exempt from registration requirements regardless of the nature of the sale, usually because the issuer is deemed low risk or is publicly accountable. This category includes obligations of the United States government, municipal bonds, and commercial paper with a maturity of less than 9 months. Because these assets are viewed as secure or already subject to stringent government oversight, the state does not require a formal registration process to protect investors. Conversely, an exempt transaction refers to the specific circumstances of a trade rather than the underlying asset itself. For instance, an isolated non-issuer transaction, which might involve a trade between two private parties where no broker-dealer is involved, is generally exempt. These distinctions prevent the regulator from imposing unnecessary bureaucratic costs on trades that pose minimal systemic risk to the public. The regulatory framework also provides specific exemptions to facilitate efficient capital formation, such as those governed by Regulation D. These private placement rules allow issuers to raise capital without registering the offering if they limit the number of non-accredited investors and refrain from general solicitation. The state administrator retains the authority to void or condition these exemptions if a firm fails to act in good faith or engages in fraudulent conduct. Furthermore, institutional transactions, such as those involving banks, insurance companies, or investment advisors, are categorized as exempt because these entities are assumed to possess the financial sophistication necessary to evaluate risk without full disclosure documents. Unsolicited brokerage orders where the client initiates the trade without a recommendation from the representative are likewise exempt because the firm is acting merely as a facilitator rather than a salesperson. Recognizing when these exemptions apply allows an advisor to maintain compliance while executing orders that meet the specific liquidity needs of their institutional or retail clientele. See you in the next lecture. Welcome back. We are now turning our attention to the foundational legal obligations of an investment advisor regarding their contractual relationships and fiduciary status. This module focuses on the rigid standards governing how advisors must formalize their commitments to clients and manage the inherent power imbalances within those arrangements. The primary requirement for an investment advisor is the existence of a definitive written contract with the client. It is not enough to have a verbal understanding or informal email correspondence. The Uniform Securities Act and the Investment Advisors Act of 1940 require that the terms of the advisory relationship be documented in a signed agreement. This contract acts as the structural foundation of the fiduciary duty, ensuring that both parties understand their rights and, more importantly, their expectations for conduct. When we speak about fiduciary mandates, we are talking about the overarching requirement to act in the client's best interest, which means that the contract cannot be used to waive compliance with regulatory requirements. Any provision that attempts to limit the advisor's liability for failure to provide adequate care or for negligence is fundamentally unenforceable and violates the principles of regulatory oversight. This is why the use of hedge clauses designed to shield an advisor from their professional liability is strictly prohibited. When looking at the fee structure, transparency is the absolute minimum standard. The contract must clearly articulate how compensation is derived, whether it is a percentage of assets under management, a fixed fee, or an hourly rate. A critical area for exam purposes is the prohibition of performance-based fees for non-qualified clients. Generally, advisors are prohibited from entering into contracts that correlate their compensation directly to capital gains or capital appreciation in a client's account, except for qualified clients who meet specific net worth or asset thresholds. This rule is designed to prevent incentives that might lead an advisor to take on excessive, speculative risk in an effort to boost their own take-home pay at the expense of the client's long-term stability. If you see a question about fee models, always check whether the suggested structure relies on speculative performance or objective, predictable billing practices that are clearly defined within the written agreement. Assignability is another area where the law is explicitly protective of the client. Under no circumstances can an advisory contract be assigned to another party without the explicit written consent of the client. If an advisory firm decides to merge, sell its business, or transfer its book of business to another entity, the original contract ceases to be effective for the new firm unless the client agrees to the assignment after notice. Furthermore, the firm has an affirmative duty to notify the client of any change regarding the composition of the partnership. While a change that does not constitute a change in control might only require notification, a transaction that involves a transfer of majority interest or control requires a formal client consent process. Understanding these nuances is essential because the fiduciary relationship is personal to the client. The client engaged the specific firm or individual advisor, and the law assumes that they should have a veto power over who handles their financial future. Termination clauses are the final piece of this puzzle, and they must be handled with mathematical fairness. The contract must outline the procedure for termination by either party, and it must include a provision for the pro rata return of any prepaid fees. If a client terminates their contract in the middle of a quarter, the firm is only entitled to keep that portion of the fee earned up to the point of termination. Failure to calculate this refund accurately is not just a breach of contract, It is a regulatory violation that suggests an appropriation of client assets. You must interpret these rules as the regulator does. The advisor is a steward of the client's capital, and every contractual provision must reflect an alignment with the client's financial well-being rather than the convenience or profitability of the firm. Keep these legal boundaries in mind, as they provide the framework for every other operational decision you will make in your professional practice. See you in our next session. Hello, welcome back. In this lesson, we will explore the mandatory frameworks for identifying, mitigating, and disclosing conflicts of interest within an investment advisory relationship. At the core of the fiduciary standard lies the mandate to act in the best interest of the client, which requires absolute transparency regarding any potential or actual conflicts. An investment advisor occupies a position of trust, and maintaining that trust requires more than just good intentions. It necessitates a structured procedural approach to disclosure. When an advisor's incentives are aligned with their own financial gain rather than strictly with the client's objectives, a conflict of interest exists by definition. It is not necessarily illegal to have these conflicts, but failing to disclose them in a way that allows the client to provide informed consent is a violation of the Investment Advisors Act of 1940 and the Uniform Securities Act. You must understand that the regulator views the failure to manage these situations as a failure of the fiduciary duty itself, which can lead to severe administrative and legal consequences for the firm and the individual representative. Multi-tier compensation models often create the most common friction points where disclosures are required. For instance, consider an advisor who charges a wrap fee for comprehensive management, meaning a single fee covering both advisory services and transaction costs, while simultaneously receiving commissions via an associated broker-dealer. This arrangement creates a clear incentive to churn the account or trade unnecessarily to generate commission revenue, which is why regulators demand explicit documentation on Form ADV Part 2A. Furthermore, the practice of accepting soft dollar arrangements, where an advisor uses client brokerage commissions to pay for research or other services provided by a broker-dealer, must be quantified and explained. Clients should clearly understand that the free research the firm receives is effectively paid for using their trade execution costs, and this must be disclosed to ensure the client is not being disadvantaged by the routing of their orders. Beyond compensation, advisors must navigate complex waters when recommending proprietary products or executing principal and agency cross-transactions. When an advisor recommends a security that the firm or its affiliates own, or a product developed in-house, the potential for self-dealing is elevated significantly. In a principal cross-transaction, the firm buys or sells securities for or from its own inventory to the client's account, which poses a risk of price manipulation. Consequently, these transactions generally require specific client consent, often in writing, prior to the completion of the trade to ensure the client is aware of the firm's dual role. Furthermore, referral fees paid to third parties or received for sending clients to specific service providers must be fully transparent to prevent hidden inducements that could compromise the quality of the investment advice provided. The mechanism for this transparency is primarily the Form ADV, which serves as the primary disclosure document provided to the Securities and Exchange Commission or the state regulators. You must ensure that the brochure and brochure supplements are frequently updated to reflect any changes in business practices or new potential conflicts that arise. However, relying solely on a massive document provided at the start of a relationship is rarely sufficient to meet the spirit of the law in the eyes of regulators. Direct, plain English communication with the client remains the gold standard for conflict disclosure, as it confirms that the client actually understands the nature of the conflict and how it might impact their portfolio. The ultimate test is whether a reasonable investor, when fully informed of the conflict, would still reasonably believe that the advisor's recommendation remains rooted in the best interest of the client's specific financial plan and risk profile. I will see you in the next lecture. Welcome back. In this lecture, we are going to explore the regulatory framework surrounding custody, specifically defining what it means to have custody and how to maintain compliance under NASAA and SEC rules. Custody is a transformative status for an investment advisor because it fundamentally alters the legal obligations and the level of scrutiny applied to the firm. Simply put, you have custody if you hold, directly or indirectly, client funds or securities, or if you possess the authority to obtain possession of them. This definition is intentionally broad to prevent advisors from circumventing the rules. It is not limited to physical possession in a vault. If you act as a trustee for a client, accept a check made out to you by a client, or have the power to withdraw money from a client's account through standing letters of authorization, you have custody. The regulatory concern here is that once an advisor has access to assets, the risk of misappropriation or gross mismanagement increases significantly. Therefore, the law demands stringent safeguards to protect the investor from the potential abuse of this delegated power. One of the most frequent sources of inadvertent custody occurs when clients mistakenly mail checks made payable to the investment advisor instead of the qualified custodian. NASAA rules provide a specific safe harbor for this situation, but it is a narrow window. If you receive a check that is inadvertently sent to you, you must return it to the sender within 3 business days to avoid being deemed as having custody. If you hold it longer than that, you are legally considered to have custody and must then adhere to all the associated compliance burdens. This 3-day rule is a strict liability trigger, so your office must have robust mail handling procedures that essentially act as an automated filtration system. Any staff member opening mail needs to understand that a check payable to the advisor is a red flag that requires immediate administrative action to remain compliant. For firms that intentionally maintain custody, the regulatory requirements are rigorous and designed to provide transparency. The gold standard for compliance is the use of a qualified custodian, which is usually a bank or a registered broker-dealer, to hold the physical assets. You must ensure that the custodian sends an account statement directly to the client at least on a quarterly basis. Relying solely on your own internal reporting is insufficient and illegal, as the client must have an independent source of truth to verify their holdings. Furthermore, you must engage an independent public accountant to conduct an unannounced surprise exam annually to verify that the assets exist and are accounted for. This audit adds an external layer of validation, ensuring that the books and records maintained by the advisor align with the physical reality of the assets held. Beyond quarterly statements and surprise audits, custody status also impacts your capital requirements. Advisors with custody are generally required to maintain a higher level of net worth compared to firms that do not have access to client assets. This is an essential buffer intended to protect clients in the event of an advisor's business failure or professional liability claim. If your firm's net worth falls below the required threshold, you must notify the regulator promptly. Compliance here is not a consultative process. It is a rigid, technical standard. You are expected to monitor your net worth regularly to ensure that you are never in a position where your financial health could potentially endanger the safety of the assets under your management. The interplay between these operational rules ensures that the advisory industry remains focused on fiduciary protection rather than asset control. I look forward to our next session together. Welcome back to our ongoing exploration of the legal and ethical landscape governing investment professionals. In this session, we investigate the boundaries of permitted conduct by examining prohibited market transactions and fraudulent client communications. Market manipulation represents a fundamental betrayal of the integrity of the securities markets and is strictly prohibited under both state and federal law. Tactics such as wash sales involve the simultaneous purchase and sale of the same security by the same party to create the illusion of active trading volume where no actual change in beneficial ownership has occurred. Similarly, painting the tape involves a group of individuals engaging in a series of transactions to create the false impression of market activity, thereby enticing unsuspecting investors into ill-conceived positions. Pool activities, where traders aggregate capital to control the price of a stock through coordinated trading, fall under the same regulatory umbrella of illegal behavior. These actions are designed to artificially influence security prices, and regulators aggressively pursue enforcement actions against any advisor or firm attempting to distort market pricing mechanisms. Each of these practices distorts the principles of fair and open competition that the Uniform Securities Act seeks to uphold. Beyond general market manipulation, advisors must be vigilant regarding specific conflicts and abusive practices when interacting with client accounts. Front-running, which involves executing trades for oneself or the firm before filling large client orders to benefit from the resulting price movement, constitutes a serious violation of fiduciary duty. Unauthorized trading is also strictly prohibited, as every trade must be executed in accordance with the client's explicit instructions unless formal discretionary authorization has been granted. Churning, or excessive trading in a client's account for the primary purpose of generating additional commissions rather than serving the client's investment objectives, is another primary enforcement target. Furthermore, the practice of borrowing money or securities from clients creates an inherent conflict of interest and is generally disallowed, with few exceptions for institutional or familial relationships. Sharing in the profits or losses of a client's account is likewise restricted to prevent the advisor from taking undue risks with client capital for personal gain. Integrity becomes even more critical when we address the handling of material non-public information, often referred to as insider trading. The Insider Trading and Securities Fraud Enforcement Act of 1988 imposes stringent liabilities on anyone who trades on or communicates information that has not yet been disseminated to the general public. This captures the tipper-tippy relationship, where providing information that results in a trade, even if the individual providing the information does not personally execute the transaction, creates strict accountability. To mitigate these risks, firm-wide compliance structures must include comprehensive internal controls to prevent the flow of sensitive data. Professional firms are required to implement and maintain Chinese walls, which are information barriers designed to physically and electronically isolate departments, such as investment banking, from research and advisory units. These barriers ensure that access to proprietary information is restricted to only those who strictly need it for their specific functional responsibilities, effectively neutralizing the risk of inadvertent insider trading across the organization. Compliance with these standards is not merely a formality, but the mechanism by which the industry maintains its structural legitimacy. An advisor demonstrates professional duty by prioritizing the transparency of all transactions and the sanctity of confidential client information. Any departure from these regulatory standards subjects the individual and the firm to severe disciplinary measures, including fines and the permanent loss of registration. You must analyze every action through the dual lens of regulatory requirements and the broader fiduciary responsibility owed to your clients. Whenever an action risks blurring the lines between firm benefit and client interest, the ethical default must always be complete transparency or complete abstention. Diligence in these matters ensures that you remain protected from the substantial legal liabilities associated with fraudulent conduct and market manipulation. See you in our next lecture. Welcome back. Today we examine the specific regulatory landscape governing how investment advisors communicate their services to the public. The regulatory framework for advisor marketing has undergone significant modernization, primarily through the SEC's comprehensive marketing rule. At its core, the rule prohibits any communication that is false or misleading, representing a broad anti-fraud standard that applies to everything from formal brochures to informal social media posts. An advisor is considered to be disseminating an advertisement if they offer investment advisory services with regard to securities to prospective clients, or offer new advisory services to current clients. This definition is expansive, covering direct written communications, emails, and even content posted on public social media platforms. The central concern is always the prevention of deception, ensuring that potential clients can make informed decisions based on factual, verifiable information rather than unsubstantiated claims or cherry-picked successes. When you evaluate these regulations, consider the perspective of the regulator, who expects full transparency in every interaction between the firm and the investing public. Testimonials and endorsements are perhaps the most sensitive areas within this regulatory architecture. Historically, advisors were sharply restricted in their use of client testimonials, but the current rule permits them, provided that specific disclosures are clearly made. You must disclose whether the person providing the testimonial is a current client, whether they receive cash or non-cash compensation, and any material conflicts of interest resulting from that arrangement. This is not merely a formality. It is an essential safeguard against the perception that an advisor has purchased a glowing review. Furthermore, if you choose to use third-party ratings or badges, such as those found on professional networking sites or financial ranking platforms, you must ensure they are not misleading. An unapproved or biased badge that implies a level of expertise not supported by a rigorous, objective methodology is inherently problematic and creates a direct violation of regulatory standards. Performance advertising represents another high-risk area where precision is non-negotiable. If an investment advisor chooses to include historical performance results in marketing materials, those results must generally be presented on a net of fees basis. Showing performance only on a gross basis without concurrent evidence of the impact of fees is considered inherently misleading because it disguises the actual return the client would have realized. Furthermore, you cannot selectively present only those time periods that happen to look favorable while omitting others. The presentation must be across time frames that are fair and representative of the firm's actual track record. If an advisor highlights a specific strategy, the presentation must include the relevant performance for appropriate periods, typically at least 1, 5, and 10 years. These rules exist because performance is the primary metric by which many investors compare firms, and regulators are acutely aware of the temptation to manipulate this data to gain a competitive edge. Social media and digital communications add a layer of complexity to compliance that every advisor must navigate with care. The distinction between interactive commentary and static marketing is vital for your understanding. An interactive post, such as a real-time response on a social platform, is treated differently than a static advertisement. Yet both must conform to the anti-fraud provisions of the Investment Advisors Act. Before any marketing content is used, it should undergo pre-approval by a designated supervisory person within the firm to ensure that it aligns with both federal and state compliance requirements. This workflow is intended to prevent the dissemination of false information regarding registration status or advisory capacity. Any claim that implies that the advisor has achieved a specific level of performance or is registered as a result of governmental approval is strictly prohibited. The focus remains on accurate, balanced disclosure that respects the fiduciary duty owed to the client. See you in the next lecture. Welcome back. In this lesson, we examine the intersection of cybersecurity protocols and the regulatory mandates governing record-keeping for investment advisors. Ensuring the integrity and confidentiality of client data stands as a core component of the fiduciary duty an investment advisor owes to its clients. Under the NASAA model rules, firms must implement a robust cybersecurity program that addresses the specific risks associated with electronic information systems. This begins with vulnerability assessments, which identify potential weaknesses in the firm's digital perimeter. Multi-factor authentication is now considered a baseline requirement for protecting account access, effectively mitigating risks associated with stolen credentials. Data encryption, both in transit and at rest, serves as a primary defense against unauthorized interception. Furthermore, firms must develop a comprehensive incident response plan to ensure timely containment and reporting should a breach occur, as the ability to act quickly is paramount in minimizing client harm. Beyond technical defenses, advisors must adhere to federal privacy laws such as Regulation SP, which governs the treatment of non-public personal information. This rule necessitates that firms provide clients with a clear privacy notice at the commencement of the relationship and annually thereafter, detailing how the firm collects and shares data. Crucially, the regulations establish a framework for client opt-out rights, allowing individuals to prevent the sharing of their personal data with non-affiliated third parties. Additionally, the red flags rule requires firms to form a program specifically designed to detect, prevent, and mitigate cases of identity theft. This involves monitoring account activities for suspicious patterns, such as address changes immediately followed by withdrawal requests or unusual communication patterns that may indicate a compromised identity. Operational resilience is addressed through business continuity planning, which mandates that advisors prepare for disruptions ranging from local infrastructure failures to widespread natural disasters. A firm must maintain an updated plan that outlines how business functions will continue during an emergency, including the protection and recovery of essential data. This continuity plan is not merely a document, but a functional strategy that involves identifying mission-critical personnel and ensuring that systems can be retrieved from secure backups. The goal here is to protect the firm's ability to service client accounts or fulfill obligations when faced with an unexpected, unavoidable operational challenge. Failure to maintain such a plan exposes the firm and its clients to unnecessary risk, which is a focal point during regulatory examinations. Regarding the maintenance of records, The Uniform Securities Act dictates a clear 5-year retention schedule for primary advisory records. For the first 2 years of this period, these documents must be kept in an easily accessible location, meaning that an examiner should be able to retrieve them during an initial audit sweep without significant delay. Electronic record keeping is the standard, provided that the firm can ensure the records are stored in a non-rewritable, non-erasable format that prevents unauthorized alteration. To protect against hardware failure or site-specific catastrophes, firms are required to store a duplicate copy of these records in a separate location. This separation of backups ensures that even if the primary office suffers a fire or digital corruption, the record trail required for regulatory oversight remains intact. Adherence to these standards is not simply about avoiding a fine during a sweep, but about building the foundation of trust upon which the advisory relationship is built. You must remember that regulatory authorities prioritize access to information as the primary way to verify whether an advisor is acting in their client's best interest. When documenting communications or investment decisions, clarity and consistency in formatting are essential for ensuring that future auditors can interpret the firm's actions accurately. Should an audit occur, you will be expected to present these records promptly, which reinforces the necessity of maintaining robust digital archiving systems. By treating these cybersecurity and record-keeping rules as fundamental operational requirements, you position your practice to pass regulatory scrutiny while simultaneously safeguarding the assets and privacy of those who trust you with their financial futures. I will see you in the next lecture. Welcome back. We are beginning a new chapter focused on refining your diagnostic approach to the exam requirements. This chapter is designed to transition you from passive learning to active mastery through rigorous performance tracking and targeted remediation of your study habits. In this session, we will address the systematic approach required for diagnostic assessment and domain review. The goal is not merely to memorize facts, but to develop the analytical capacity to isolate your conceptual vulnerabilities across the 4 primary domains of the Series 65 exam. You must treat this assessment as a laboratory environment where you objectively measure your current understanding of economic concepts, investment vehicle mechanics, portfolio theory, and the dense web of regulatory statutes. If you approach this simply as a way to check if you remember a definition, you are missing the point of diagnostic work. Instead, you need to dissect every wrong answer to understand the specific mental model that led you astray. By mapping these gaps directly back to the regulatory codes and financial principles we have discussed, you transform a simple error into a high-value learning opportunity. Performance tracking requires a structured feedback loop that goes beyond just looking at a raw percentage score. You should be maintaining a log that categorizes your errors by domain, such as identifying whether a mistake stemmed from a misapplication of modern portfolio theory or a misunderstanding of state-level registration requirements for investment advisor representatives. This granularity allows you to implement a targeted remediation plan rather than wasting time reviewing entire chapters of material you already understand. Focus your attention on the underlying formula or the legal statute that dictated the correct answer in the first place, rather than the surface-level scenario presented in the diagnostic question. This is how you build the mental resilience required to handle the ambiguity often found in the actual examination environment. When reviewing your results, compare your metrics against the baseline expectations for success. This isn't about competing with peers, but about ensuring your proficiency aligns with the standard necessary for professional advisory practice. When you find a deficit, perhaps in the nuanced area of trust governance or the specific rules governing cybersecurity and record keeping, you must return to the foundational principles. Ask yourself why your initial logic differed from the regulatory mandate. Was it a failure to recall the rule? Or was it a misinterpretation of how that rule applies to a specific client profile? By deconstructing these conceptual vulnerabilities, you solidify your knowledge base far more effectively than you would by simply reading text again. Effective review strategies hinge on your ability to connect fragmented pieces of knowledge into a cohesive framework. Remember that the Series 65 exam expects you to integrate your understanding of economics with your knowledge of state and federal securities laws. If you find yourself struggling with quantitative evaluation methods, do not just memorize the formula. Ensure you grasp the theoretical rationale behind why a specific measure of risk or return is used in a specific context. This holistic approach ensures that when you encounter complex, multi-layered questions, you can rely on deep-seated reasoning rather than fleeting memorization. Stay disciplined in documenting these cycles of assessment and review, as this will ultimately dictate your readiness to navigate the final examination. We'll see you in the next session. Welcome to this full-scale practice examination designed to mirror the actual experience of sitting for the Series 65 exam. We are about to engage in a comprehensive simulation that replicates the regulatory environment and cognitive demands you will face on test day. When you begin this simulation, you are essentially entering a controlled environment that requires the same mental fortitude as the real examination. You will be presented with a total of 140 questions, of which 130 are graded and 10 serve as unscored pretest items. Just like the actual FINRA exam, you must complete this set within a strict 180-minute window. This time constraint is not merely a test of your knowledge, but a test of your ability to manage pace and maintain accuracy under pressure. The software interface you are working with includes familiar features such as the ability to flag questions for later review and a countdown clock to keep you grounded. It is essential to treat every question as if it carries the weight of the actual certification, even if some items are technically unscored markers. This deliberate practice allows you to develop the muscle memory required to navigate the interface without hesitation. One of the most important aspects of this simulation is how you handle non-backtrack item distributions if you were to interact with such systems in a live setting. Yet here we focus heavily on your endurance. You need to assess how your cognitive performance shifts as you move from the initial, easier conceptual recall questions toward the more taxing quantitative evaluations or complex ethical scenarios. If you find your focus dipping halfway through the block, acknowledge that fatigue and consciously reset your attention rather than rushing to reach the end. The goal is to reach a state where the regulatory nuances and the analytical frameworks for valuation become second nature. Pay attention to how you react to ambiguity, especially when faced with questions concerning the Uniform Securities Act or fiduciary mandates where two answers may appear correct at first glance. By navigating the full 140 questions, you are building the stamina necessary to prevent the common pitfall of careless misreading during the final phase of the exam period. After the timer expires, you must approach the performance review with a forensic mindset rather than one driven by ego. Every error is a data point that reveals a specific gap in your understanding, whether it stems from a misinterpretation of a specific investment vehicle characteristic or a lack of clarity regarding registration rules. Consider how you arrived at your incorrect answers during the simulation and contrast those with the logic required by the Investment Advisors Act. If certain subject areas, such as corporate financial statement analysis or tax fundamentals, consistently yield incorrect results, you have identified your primary focus areas for further study. Do not simply observe whether an answer is correct or incorrect. Evaluate the path you took to reach your conclusion and see if it aligns with the regulatory expectations. This structured self-reflection is the only way to convert a simulated score into a reliable indicator of your actual readiness. See you in the next lecture. Welcome back to our final stretch of preparation, where we transition from understanding individual regulations to applying them within the messy, real-world context of a formal examination environment. In this session, we will dissect complex scenarios that test your ability to synthesize state registration requirements, fiduciary obligations, and compliance mandates. When we approach a dense paragraph representing a regulatory case study, our first instinct is often to try to memorize every detail provided in the prompt. This is a common trap because the examiners intentionally inject irrelevant data to cloud your judgment. Instead, you need to develop a mechanical approach to deconstructing these narratives. Start by identifying the legal status of the parties involved, such as whether an entity is an investment advisor, a broker-dealer, or an issuer. Determine the jurisdiction of the activities, as this will immediately signal whether you are applying the Investment Advisors Act of 1940 or the Uniform Securities Act. By filtering out the noise of client anecdotes that do not pertain to the specific rule, you create the cognitive space required to isolate the core regulatory conflict. Consider a scenario where an investment advisor representative is managing accounts for clients who recently moved across state lines. Questions in this domain often test your understanding of the de minimis exemption, which typically allows an advisor with no place of business in a state to serve a limited number of non-institutional clients without registration. You must differentiate between a client who is merely visiting a state and one who has established residency, as the regulatory burden shifts based on that legal distinction. If the scenario involves an institutional client, the registration rules for the advisor frequently vanish altogether. You should map the movement of the client against the specific state requirements to confirm if an exemption holds or if registration is triggered by the crossing of a threshold. Keeping these technical definitions rigid in your mind prevents the narrative details from obscuring the clear black-letter law. Fiduciary conflicts often form the backbone of the most challenging exam questions because they require you to balance the duty of loyalty against the necessity of disclosure. When presented with a scenario where an advisor suggests a proprietary product or routes trades through a preferred broker-dealer for soft dollar benefits, your focus must remain on the adequacy of the disclosure. The law is rarely concerned with the conflict itself. It is profoundly concerned with whether that conflict was disclosed in a way that allows the client to provide informed consent. Look for red flags such as misleading advertising materials that imply a guarantee of performance or fail to state the nature of the advisory relationship clearly. Identifying a breach of fiduciary duty requires you to pinpoint exactly where the advisor prioritized their own economic gain over the client's best interest without giving the client a fair look at the underlying economic reality. Custody compliance represents another area where the exam shifts from abstract rules to actionable scenario-based evaluations. If an advisor maintains custody of client funds or securities, the requirements for surprise audits, account statements, and qualified custodians become mandatory. Many exam questions hide the existence of custody in the way an advisor interacts with third-party vendors or in the language of their authorization to sweep fees from client accounts. You must distinguish between having technical custody, which triggers stringent reporting requirements, and merely having limited discretion over a portfolio. If the scenario mentions that an advisor has the ability to move funds between accounts or has access to client passwords, you are looking at a custody situation. Applying the rules correctly requires you to verify whether the advisor has met their obligation to segregate funds and engage an independent public accountant for periodic assessment. Beyond registration and fiduciary conduct, look for traps related to prohibited business practices that rely on the specific definitions found in the Uniform Securities Act. A common tactic in these questions is to describe a series of communications between an advisor and a client that may appear professional but actually violate the standards of fair dealing. These might include guarantees of future results, recommendations based on non-public information, or the failure to provide a brochure at the time of contract execution. By identifying the specific conduct as a prohibited practice, you can quickly eliminate the answers that suggest the action is permissible under standard disclosures. Always treat the disclosure document or the Form ADV as the primary instrument for compliance. If the disclosure was never provided or was materially inaccurate, the advisor has essentially failed the integrity test, regardless of the advisor's intent. The regulatory framework prioritizes the protection of the client from misleading information. Success in this section of the exam depends on your ability to treat each question as a structural problem rather than an exercise in reading comprehension. When you see a long, confusing case study, force yourself to identify the legal authority defined at the state or federal level first. Once the actor and the authority are clear, the range of possible prohibited or permitted actions narrows significantly. You are effectively acting as a compliance officer auditing a hypothetical situation, and your objective is to find the deviation from established law. This shift in mindset transforms the test from a test of memory into a test of application and professional assessment. By training your brain to scan for these regulatory triggers, you will reduce the time spent on reading and increase the accuracy of your final selection. See you in the next lecture. Welcome back. In this iteration, we focus on the practical application of client suitability through targeted scenario drills, representing a critical 30% of your examination. Building a portfolio is rarely an exercise in theoretical optimization alone, as the real complexity arises when we reconcile rigid financial realities with the idiosyncratic goals of a client. When you encounter a case study, Your first analytical step must be to strip away the noise and focus on the duration of the investment horizon and the client's actual liquidity constraints. Consider a client nearing retirement who expresses a need for capital preservation while simultaneously desiring long-term growth to combat inflation. You should not immediately default to a static asset allocation. Instead, look at the balance sheet to determine if current assets provide enough margin for error to sustain market volatility. Modern portfolio theory dictates that diversification is our primary defense against unsystematic risk. But in a test environment, you must determine if the portfolio's correlation coefficients actually align with the stated risk tolerance. If a client has a high capacity for risk but a low willingness to bear it, your recommendation must skew toward lower volatility capital markets instruments, regardless of the theoretical alpha you might capture elsewhere. Always map the proposed allocation against the client's tax bracket, as the choice between a municipal bond and a corporate bond is often settled by the client's marginal tax rate rather than the nominal yield. Managing portfolios under the lens of ERISA fiduciary standards requires a level of rigor that transcends simple performance chasing. When we evaluate qualified retirement vehicles, such as a 401k or a 403b, we are checking for the presence of sound investment policy statements that guide the selection and monitoring process. You must remember that a fiduciary is not judged by the performance of a single security, but by the prudence of the process used to arrive at the investment decision. If you are recommending an active management style for a core holding, the burden is on you to demonstrate why the potential for outperformance justifies the higher expense ratio compared to a passive index strategy. This assessment is fundamental when dealing with ERISA-governed accounts, as the selection must prioritize the participant's interests above all else, keeping costs reasonable and diversified. If a client possesses significant tax-deferred assets alongside taxable brokerage accounts, asset location becomes your most potent tool for tax-efficient wealth accumulation. Placing high-turnover funds or tax-inefficient assets within a tax-advantaged account is a standard best practice that you should be prepared to identify immediately in a scenario-based question. Analyzing the nuance of client entities such as trusts or estates introduces further variables regarding the mandate of the fiduciary. You are essentially balancing the needs of current income beneficiaries against the long-term wealth preservation required for remainder beneficiaries, commonly known as the duty of impartiality. In these scenarios, watch for specific instructions within the legal documents that might override the default requirements of the Prudent Investor Act. For example, a trust might explicitly forbid the sale of a family legacy business, creating an undiversified concentration that you must somehow balance in the remaining portion of the portfolio. Active management might be required here to hedge the specific risk presented by the concentration, or perhaps a derivative strategy is appropriate to manage downside exposure without triggering taxable events through the sale of the underlying asset. The interplay between these legal constraints and the client's cash flow needs serves as the primary pivot point for many exam questions. Always ensure that the strategy remains consistent with the life cycle of the beneficiary and the anticipated distribution schedule outlined in the governing instrument. Ultimately, the goal is to develop an intuition for which financial variables in a scenario are actionable and which are distractions. A client's age is merely a starting point, whereas their specific debt-to-income ratio and upcoming large capital expenditures act as definitive constraints on your recommendations. If you find yourself overcomplicating a portfolio design, pause and return to the primary investment objective. Is it growth, income, or capital preservation? By aligning every recommendation with the basic tenets of asset allocation and the regulatory requirements of your profession, you ensure that the portfolio is not only high-performing, but also defensible under audit. Mastery of these scenario drills will allow you to quickly categorize the client's profile and select the model that fits their economic reality. Practice identifying these patterns until the linkage between the client's financial statement and the resulting asset allocation becomes intuitive. I will see you in the next session. Welcome back to our journey through the Series 65 curriculum. In this session, we will focus exclusively on the quantitative methods and financial formulas required to navigate the evaluative portions of the exam. Precision in financial calculations is not merely an academic exercise, but a core competency for an investment advisor representative. When you encounter questions requiring quantitative analysis, the underlying logic is often more important than the arithmetic itself. We will dissect how to translate raw data from financial statements into meaningful metrics that drive investment decisions. By understanding the mechanical relationship between variables, you reduce the cognitive load during the actual exam. This clarity allows you to move past the intimidation of complex formulas and focus on the practical application of these metrics in a professional setting. We will walk through the construction of ratios, the interpretation of sensitivity models, and the nuances of valuation math. Mastering these patterns ensures that you do not simply memorize equations, but rather internalize the economic narratives they reveal. We begin our technical review with the fundamental balance sheet ratios that offer a snapshot of a company's financial health. The current ratio and the quick ratio serve as primary indicators of short-term liquidity, and understanding them requires looking at how current assets relate to current liabilities. When calculating the debt-to-equity ratio, you are measuring the degree of financial leverage employed by an entity, which provides essential context regarding a firm's risk profile. These liquidity and solvency ratios are straightforward, yet they require consistency in your approach to ensure you are categorizing ledger items correctly. Similarly, mastering equity valuation metrics like the price-to-earnings ratio or the dividend discount model allows you to assess whether a security is reasonably priced relative to its fundamentals. These tools provide the skeleton upon which professional investment analysis is built. Consistently applying these formulas prevents calculation drift, where minor errors early in your process compound to distort your final valuation. Shifting our focus to debt instruments, the calculation environment changes as we introduce time value variables. You must be comfortable distinguishing between current yield, which is a static measure, and yield to maturity, which incorporates the price discount or premium amortized over the bond's remaining life. Bond duration is another critical concept, acting as a measure of sensitivity to interest rate fluctuations. When interest rates rise, bond prices fall, and the magnitude of that decline is dictated by duration. For your examination, you do not need to perform complex calculus, but you must be able to estimate the inverse relationship between maturity, coupon rates, and duration. By keeping these mechanical relationships in mind, you can quickly evaluate how a portfolio's fixed income sleeve might react to changes in the prevailing monetary environment. Beyond static financial statements, we must address the quantitative methods used to evaluate portfolio performance and risk. The Sharpe ratio is our primary tool here, as it balances the excess return of an investment against the volatility or standard deviation incurred to achieve that return. When you calculate the Sharpe ratio, you are essentially determining the efficiency of a portfolio relative to a risk-free benchmark. Standard deviation itself serves as the proxy for total risk, and you should be prepared to discuss how it behaves under different diversification scenarios. The inclusion of alpha and beta further refines this view, where beta measures systematic risk sensitivity relative to the market, and alpha represents the value-added performance of the manager. These tools are the language of performance attribution, and you must translate these raw numbers into conclusions about risk-adjusted returns. Finally, we arrive at capital budgeting metrics, specifically net present value and internal rate of return. These concepts are rooted in the idea that money today is worth more than the same amount in the future due to its earning potential. Net present value requires you to discount future cash flows back to the present day using a specific required rate of return. If the result is positive, the project or investment is theoretically additive to value. The internal rate of return is the discount rate that makes the net present value of all cash flows equal to zero, providing a singular percentage figure to compare against alternative hurdles. Understanding these models is vital for evaluating capital projects or complex multi-stage investment opportunities. While the math can appear cumbersome, the underlying conceptual goal is always to determine if the expected returns compensate adequately for the time and risk involved in the expenditure. See you in our next conceptual deep dive. Welcome to this final preparation briefing, where we focus on bridging the gap between your conceptual knowledge and actual exam performance. We start by acknowledging that cognitive exhaustion is as much an enemy as any difficult question on the Uniform Securities Act. You have covered the nuances of the Investment Advisors Act of 1940 and the complex legal definitions of fiduciary duty, so now we must sharpen your operational efficiency. Consider the high-yield notification deadlines. Remember that any material change to your Form U-4, such as a change in residential address or a new criminal conviction, must be updated within 30 days. If you find yourself facing an unfamiliar legal definition, rely on the core principle that the Uniform Securities Act is designed primarily for the protection of retail investors within the state. When testing, you should approach every question by first identifying the regulatory capacity involved, as the obligations of an agent differ significantly from those of an investment advisor representative. By keeping these jurisdictional and functional boundaries clear, you reduce the margin for error when answering questions about exemption status or registration requirements. Strategic guessing is a formal technique that involves the systematic elimination of logically impossible options rather than random selection. When you encounter a question that seems designed to confuse you through complex wording, start by identifying the outliers among the four choices provided. Exam writers often use semantic traps by including absolute terms, like always or never, which are rarely correct in a regulatory environment defined by specific exceptions. If you can eliminate two clearly incorrect options, your probability of success increases dramatically, making it a sound decision to commit and move forward. Managing exam anxiety requires acknowledging it as a physiological response to pressure. Treat the testing workstation like any other professional interface you use in your daily workflow. Ensure your identification documents are ready, and strictly adhere to the test center's arrival guidelines regarding personal items and prohibited materials. Consistency in your environment and your process creates a mental buffer that protects your performance during the longer sections of the evaluation. Operational details concerning your post-exam life are crucial to your professional transition once you receive a passing score. The Form U-4 filing process is not a passive task, but a critical component of your ongoing compliance responsibility as an investment advisor representative. After the exam, ensure you have documentation verifying your completion and keep a record of your registration status update. Many candidates overlook the fact that administrative compliance begins the moment you enter the industry, not after you secure your first set of clients. You should maintain high standards for your record keeping immediately, as the regulatory scrutiny on advisory practices has intensified significantly in recent years. By treating the exam experience as a dress rehearsal for your regulatory life, you build the habits that prevent common oversight failures. Efficiency at the testing center is the final step in a process that demonstrates your readiness to operate within the strict legal framework established by the state and federal authorities. See you in the next lecture. Welcome back, and congratulations on maneuvering through the entirety of this Series 65 curriculum. We have now reached the final review of our training program, which marks the completion of all required regulatory and financial planning modules. In our journey together, we have methodically disassembled the core components of the investment advisory profession. We began with macroeconomics, where we analyzed how monetary policy, yield curves, and inflationary pressures dictate the behavior of capital markets. From there, we moved into the quantitative side of the house, dissecting financial statements to uncover the health of corporate entities and evaluating risk profiles through systematic and unsystematic lenses. We spent significant time building an understanding of investment vehicles, ranging from basic equity and debt instruments to complex derivatives and pooled investment structures like mutual funds and ETFs. Crucially, we navigated the bridge between theory and practice by looking at client profiling, tax fundamentals, and the intricacies of wealth transfer. Finally, we grounded all of these technical functions in the rigorous framework of the Uniform Securities Act and the Investment Advisors Act. It is important to recognize that these domains do not exist in isolation when you are sitting in the chair of an investment advisor. Your daily operational life is defined by the tension between providing optimal portfolio returns and adhering to fundamental fiduciary duties. When you recommend a specific asset allocation, you are simultaneously balancing modern portfolio theory against your client's unique risk tolerance and fiduciary obligations. You are expected to manage conflicts of interest through transparent disclosure and to ensure that your advertising and cybersecurity practices remain in strict compliance with federal and state mandates. The Series 65 is not merely a test of mathematical formulas or legal definitions. It is an assessment of your ability to synthesize these disparate elements into a coherent, compliant advice model. By viewing these subjects as a unified ecosystem, you prepare yourself not just for the exam, but for the actual responsibilities of professional practice. Once you have successfully passed your examination, your transition into the professional sphere requires attention to immediate administrative requirements. The path forward involves moving from being an exam candidate to a functioning investment advisor representative, which primarily happens through the Investment Advisor Registration Depository. Your firm will initiate the submission of Form U-4, which serves as your primary record in the Central Registration Depository System. This document is the cornerstone of your professional registration, and you must review the disclosures contained within it with the utmost care for accuracy. Your registration status is dynamic. It requires active state licensing approvals, which may vary depending on the jurisdiction where you provide advice. Any changes in your employment, disciplinary history, or residential status must be communicated through your firm to update your U-4, as failures in this process can result in significant regulatory scrutiny. Long-term success in this field is predicated on the understanding that regulatory compliance is a continuous process rather than a static accomplishment. The North American Securities Administrators Association, or NASAA, has established a formal framework for continuing education that you must integrate into your professional life. This framework currently mandates a 12-hour annual continuing education requirement for investment advisor representatives, consisting of specific ethical and practice-related segments. Staying compliant with these mandates ensures that your knowledge remains current with shifting regulatory environments, cybersecurity threats, and emerging financial products. Maintaining your registration is a professional obligation that protects both your firm and the investing public from outdated or negligent advisory practices. View this requirement as a structured opportunity to iterate on your professional competency throughout the course of your career. See you in the next step of your professional journey.